interruption, liquidity shrink was interrupted when Bank of Japan changed YCC. They went in and they bought $400 billion worth of bonds to defend their bond market. Very odd situation. They raised rates, but then liquidity exploded on it. And then obviously the debt ceiling. Secretary Yellen drew down the TGA, that's basically the Treasury savings account, from $700 billion to practically nothing last week. That also ended up in non-issuance of government debt, so that was a big boost to liquidity. All that is set to change now. Actually, the TGA is going to go the other way. She's already stated she wants to build it back up to normal levels, so you're going to have probably about $800 billion in treasuries issued between now and year end. The Fed will be continuing on with QT. You've got the student loan thing, which I think has kept consumption up. That's all changing in September. They're going to have to actually, God forbid, in the United States, somebody actually pays interest on a loan. So to me, the probabilities haven't changed. It's been pushed out relative to expectations, but in no way does the fact that it hasn't started yet change the probability of whether it's going to be hard or soft. I would actually argue, since it's taken so long, the Fed has ended up with a higher terminal rate. And in fact, inflation gets stickier the longer it stays in the system, that it increases, not decreases, the probability of a hard landing. By the way, after the 87 crash, I was convinced we're going to have depression. So I've been wrong before, and if I'm wrong on this, I'll adjust. But I have to weigh the probabilities and do what I do with my process, and right now, that's where we are.
And when?
I have been, I think September is the first time when I was sort of a afraid of booming economy inflation guy to I'm more worried about growth than I am about inflation. And originally I was fourth quarter of 23. I temporarily maybe lost my mind, or maybe I was right when the Silicon Valley thing happened and got anecdotals and stuff that has traditionally led, like trucks and retail, move that up to now. I think I'm probably wrong, and I'm going to go back to the end of 23. But the real answer is I don't know.
So recession or no recession, though, one thing that's interesting, and you included, a lot of people are very encouraged by certain areas of the market, particularly the AI boom.
There's always stuff to do. We had a hard landing in 74, 75, and chemicals and oils and that stuff did great. I'm sorry, go ahead and answer your question.
Well, do you think that all of AI makes it through this recession, or do you think that some areas of the market, particularly in AI, start to look like they're in bubble territory?
Well, all of AI is not going to make it through whether we have a recession or not, because they haven't separated the wheat from the chaff yet. But I do believe, unlike crypto, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like NVIDIA, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that NVIDIA goes down despite the lofty valuation level. History has proved if you have very good earnings in a recession and they're sustainable, if they're not, the market somehow figures it out, those stocks will do just fine. So we have some longs, we have some shorts, and the AIs have sort of dominated the long portfolio for 5 or 6 months.
How do you think about going short in this market?
Our shorts have been fine this year, except my index shorts, which have been a disaster. But we always short the same way. I just try and look at the current situation, and then I try and think of a situation 12 to 18 months from now based on my forecasts. And I think if I think the security prices are going to be less, then I short them. Frankly, I'm not sure I've ever made money. If I took back the last 40 years, I'm afraid to look. I've never had a down year, but I'm not sure I've made money in shorts. I like it, it's fun, but you can get your head handed to you. And it's a game that really only professionals, and the math's against you. If you're dead wrong on a long, you can lose 100%. If you're dead wrong on a short, you can lose 10 times your money. And when I was at Soros, I shorted $200 million worth of internet stocks in March of '99, and in 3 weeks covered them at a $600 million loss. I lost $600 million on a $200 million investment in 3 weeks. I was short 12 stocks. They all went bankrupt, every one of them.
Don't try that at home.
So,
well, I mean, to that point, when you look at the AI kind of boom here, are there lessons to be learned from the dot-com bubble?
yeah, there are definitely lessons to be learned. Don't get emotional, don't get crazy. But I will say this about the AI. NVIDIA bottomed in October in the low 100s. It's true, it's 380 or 390, it's in nosebleed territory. If this is a secular move, if this thing is real, you just don't have 10-month moves. That's not how it works. Even the dot-com bubble lasted 2.5 years. For many of the guts of the internet, it lasted 4 years. The Ciscos, the Sun Micros. So, could NVIDIA go down materially in the short term from any point? Yes, but I would be surprised if I'm right on AI and the impact on it. I mean, it's already making the top coders 7 to 8 times more productive than they were 5 months ago. If it's as big as I think it is, NVIDIA is something we're going to want to own for at least 2 or 3 years, not for 10 months, and maybe longer.
Certainly the topic du jour. There's another thing that a lot of investors are talking about. It's the promise of China. This idea, and it's time to get your global view here because so many people rely on you for the macro perspective. The view here is that the GDP in China will expand faster than the United States, and a lot of investors are kind of shaking off geopolitical tensions on the back of that theory. Do you see the same promise that the China bulls are seeing?
I do not. I was in love with China until about 6 or 7 years ago. You go over there and the energy in Shanghai was like New York on crack. I mean, it's just fantastic energy. The entrepreneurs were exciting. They were into it. And then Xi Jinping did his thing. And if you look at China and the rise of China, I think it all sort of happened. You had this internal capitalist system with a bunch of people that act like crazy New Yorkers, building new businesses in a dynamic economy. But he has proved he's not a capitalist. He's definitely not a monopolist. There's only room for one monopolist in China in his mind, that's him. Anybody that gets their heads stuck up. And I honestly think he either doesn't understand why China grew and succeeded the way they did, or frankly, he doesn't care, because in terms of staying in power. But I would be looking out 10 or 15 years, I just don't see it. Unless there's a change in power there at the top, I think that's going to be a very undynamic economy. It's not so much the geopolitical concerns. I will say this, that if I'm right, it makes me more fearful of military action, because that's when dictators become more dangerous, is when they've got to divert attention from the immediate problem. So what they're doing now is very stimulative. We're expecting a sugar high and some kind of robust growth there, maybe for 6 to 9 months. But looking out, I do not look at them as a big challenge to the United States in terms of economic power and growth.
There's equally been a lot of investor questions about the future of Japan as well. How do you think about the opportunity set and how to invest?
When I went to Soros, Japan set me off like a rocket ship, because I shorted the Nikkei at the top. I had everything, and then I think every trade I made 5 years later and on, I've lost money in Japan. It's been the biggest value trap in history. But I will say, right now, I haven't check this, but it's by far been the deepest breadth and the best market this year. Yeah, our market's up, I think you said 12%, but it's like 7 stocks and everything else is not even up. That's not the case in Japan. The breadth is tremendous there. You have a couple things going on. They look like they're solving deflation plus, so you're getting nominal growth. They've also, it's more than just talk. They're really into the whole shareholder value thing. And then you got a guy running monetary policy, and he sounds like Jerome Powell 2 years ago. I mean, inflation's taking off there, and he's saying we haven't quite achieved our goal yet, even though he's like doubled his goal that is stated. So you put all that together, for now you have a dynamic market, but given my record trading Japan the last 15 years, you should do the opposite of what I say.
Back to the United States, I promised you politics. So we're going to get there. You know, because the fiscal will overtake the monetary pretty soon as well, especially as we look forward to a 2024 election cycle in the United States. And when you look at the wide range of Republican hopefuls who are either challenging or may challenge Donald Trump, Nikki Haley, Chris Christie, Mike Pence, Ron DeSantis, Tim Scott, Glenn Youngkin, who has your money and who has your vote?
I love Tim Scott. I'd like him to be the next president. Whether he has the name recognition, whether he's too nice a guy for this fight, I don't know. But I'm not really into dividers. I'd like to see the country united, and I think from that party, he's the one that could probably most accomplish that. I'm kind of excited about Chris Christie taking on Donald Trump. The others kind of like dance around the subject. They don't even use his name. I think somebody needs to hit him in the mouth with the way he hits people in the mouth. And Chris Christie could be very good at that. I was very disappointed the way he handled the 2016 thing. For those who don't know it, on national television, I said that Donald Trump had the economic understanding of a kindergarten of the U.S. economy on national television with John Kasich, and then I came out a year later and said I overestimated his economic standing. So just so you were not, oh no. But anyway, I don't think Chris Christie can win, but I'm excited that he's getting in the race because I think he can maybe expose Donald Trump, and he really needs to be exposed.
So what do you think about some of the other candidates, especially Ron DeSantis? You know, the way that he has approached corporations in Florida in particular, what do you think that means for him as he enters the race?
I actually think until recently he did a great job in Florida. If you look at the record, he's very smart. Not that broad in terms of the people around him. He'd have to build that going in. But despite his intelligence, it seems like his calculus is to go after the Trump voters. I don't think the Trump voters care about policy. I don't think they can be moved. And by going after the Trump voters, he's alienating the other 30 to 40% of the pie, particularly women and others that care a lot about the social issues. He's not my favorite, but frankly, if he ran against Joe Biden, I'd vote for him enthusiastically.
I wonder, you define yourself as an independent as well. Is there anybody and you voted for Democrats in the past, is there anyone in the Democratic Party that excites you?
Well, I'd love it if Gina Raimondo would run, but apparently we're going to put an 80-year-old who's going on 100 up on the ticket. I don't understand what the Democrats are doing. I voted for 2 Democrats out of the last 5 elections. I'm not like some partisan crazy person, but what are they doing? You know, I don't know. There doesn't seem to be anybody other than Bobby Kennedy who's willing to take him on. Bobby Kennedy is a little nuts, but mark my words, he's going to scare this guy, because when people go to the polls, particularly a year from now, because Joe Biden is a moving puck, I wouldn't be surprised if Bobby Kennedy doesn't get more support than any of us could imagine.
Democrat or Republican, the kind of trajectory you pointed at the very beginning of this, higher spending, no matter what. No matter what scenario we're in the next couple of years in the United States, do you think investors will be facing much higher taxes?
Eventually. How's that for a hedge? Yeah, the only way out of this is, given what I talked about earlier, taxes are going to be much higher in 20 years. If it's a Republican president, can they hold out for a few more years? I assume so, but taxes are going up. It's either that or 30 or 40% inflation, which I don't think is going to happen.
So before I let you go, I know you won't perfectly answer me on this with a lot of specificity. You've been saying...
I didn't know I had any perfect answers. Go ahead.
Well, what is the fat pitch? You've been saying that you have been kind of cautious when it comes to markets. At what point do you start to get in and you start to have a conviction trade that is much bigger?
I think my record is as much knowing not when to play as when to play. And because I deal in 5 or 6 different asset classes, I've had the luxury, if there's uncertainty in equities, usually that's a good time for bonds, and currencies are doing crazy things when the world's blowing up, so there's a lot of volatility there. And I would love to answer your question, but this is the most complicated, non-roadmap, unanalyzable situation I've ever seen in terms of having a lot of confidence in an economic prediction going forward. So I honestly, and I hate not to answer your question, I honestly don't see a fat pitch right now. What I do think is, given the change in liquidity, given everything I've outlined, some really fat pitches are going to emerge in, say, the next 8 to 24 months. And I don't want to blow my cash and be in a horrible mental state, being down 8%, making a big bet on something that I didn't have amazing conviction on when I think the roadmap is going to be good. So you talked to me about this interview in January. I probably wouldn't have accepted it if I knew that I was going to be as messed up in the head as I am right now in June, but I also thought it would be bad to cancel. So I don't have a fat pitch, but I hope I've imparted something to your audience.
Yeah, absolutely. We will ask you again in 8 months, you said. Thank you so much, Mr.
Thank you, Sonali. Appreciate it.
So, welcome everyone, and thank you very much, Adena, for spending time with us today.
Sure.
It's a hard act to follow.
That really was.
But you can do it. If anybody you can do it,
We can
you
always
can do
rely
it.
on Stan to tell us what's on his mind.
Yeah, exactly. So let me start with the most basic thing. I actually, as I mentioned, you looked you up on Wikipedia today, and it said Nasdaq is a securities exchange, which I guess it is, but I think you have a larger vision. Tell me what you see Nasdaq as being today.
Sure. Well, Nasdaq is a securities exchange, but that is our foundation. But today we really are a technology company that serves the global capital markets. So we have our own exchanges, and it's a very technology-driven part of our business. But we also then have really deepened our relationships across corporates, investors, market participants, and other exchanges with technology. So we provide the technology to 130 other exchanges around the world. We serve about 5,000 asset managers and asset owners with insights and intelligence to help them make smart asset allocation decisions. We also provide corporates with a lot of tools that will enable them to be better public companies. And then we have our anti-financial crime suite that really supports the banks and brokers around the world. So today we've really taken that foundation and really extended and expanded our relationships with our clients through technology.
So goodness knows tech is the byword right now for just about every company. And a lot of those asset managers and corporates and financial institutions have a fair amount of technology themselves. So what do they do and what do you do? What do you add to what they already are doing or want to do?
Right. Well, I think that it's really important to recognize that workflows, the world has become a lot more complicated. And therefore, we have to find ways to enable them to do their jobs better, more efficiently, as well as to give them better access to insights and that's really a data play. So to allow them to have better data, better workflow tools to be efficient and smarter in making those decisions. So with regard to asset managers and asset owners, we provide a tool that connects the asset managers and asset owners together. So an asset owner would say, I'm really interested in this strategy. I want to understand who's out there who has funds that I can invest in that strategy. What's their performance? What's their management team? How have they done? How do I make sure that I'm able to allocate assets into that strategy? So that's called eVestment, Nasdaq eVestment. And then on top of that, we then provide those asset owners with portfolio management tools that allow them to manage their portfolios very dynamically. So that's just one example. I think, as you know, in the anti-fin crime suite, we have a complete end-to-end solution to manage fraud and AML detection, investigation, and reporting for banks. And then, of course, within the exchange business, we provide our core technology to exchanges all over the world.
Yeah, and I want to get to the financial crimes issue because it's a very big issue that you're very active in. But before that, how much of what you're providing, Nasdaq is providing, is, if I can put it this way, the pipeline, the connectivity, and how much of it is the add-on of the analytics?
Well, I think certainly within the exchange business itself, it's connectivity and then, of course, the interaction of those orders within our exchange business. Within our workflow tools and analytics tools, it's a lot of intelligence. So it's really what we do with both with Nasdaq eVestment and with Verafin is they're both cloud-based tools. We pool data together across thousands of institutions, and we then are able to run very, very advanced algorithms and analytics on them, both for asset allocation decisions in one use case, and then for anti-financial crime management in the other use case. And so we are very tech forward. It's all very modern technology, and we are now running AI algorithms. I'm really focused on that in our anti-financial crime suite and starting to figure out how to leverage that over in our other businesses as well.
Because I think a lot of financial institutions have invested an awful lot in technology, particularly the big money center banks. How much of your business is with some of the smaller banks and financial institutions as opposed to the big guys who do it in-house?
Well, actually, more and more of the big banks are looking for outside technology partners, which obviously accrues to our benefit. But with Verafin, we started, and that's our anti-financial crime technology, we started with the smallest banks, actually. In a way, you have to think about every bank has a responsibility to manage out fraud, manage out money laundering, and be really great at it. And at the same time, they don't all have the same resources to do it. So with the smaller banks, Verafin really started there to say, we can provide you a single platform, end-to-end fraud and AML detection across all of your payments, whether it's wires, checks, ACH, all of those capabilities, as well as, and they look at every transaction. And the reason why they're more successful than others is that they then pooled the data. So instead of just looking at that one bank's transactions, they pull that data into a pool of 2,500 banks now, where they're able to look at patterns of behavior across all of the banks. I mean, criminals don't just bank in one bank. So they leave little data crumbs across the system, and Verafin is, we think, the best in the world in being able to root out those criminals through their algorithms. We now are going up to the largest banks. So the largest banks have used traditional on-prem technology solutions from outside firms, or they've built their own capabilities, but they're realizing that the problem is becoming more and more complex. And again, criminals don't just bank with them. So if they're able to leverage the data that we have and leverage the workflow tools we have, they'll be more effective. So we signed our first tier 1 bank last quarter, and we're running a lot of POCs where we can show the benefit of this technology across those tier 1s. And we're getting more squarely into the tier 2 banks now.
We can't have a discussion about technology without talking about artificial intelligence. And it's been around for a while, actually, but certainly since ChatGPT, really a great marketing move, by the way.
Yes, it is.
OpenAI. But we all talk about it. Tell me what you're doing right now in terms of the modernization of the markets with AI already, and where do you see it going?
Yeah, I mean, first of all, we have been leveraging AI within Nasdaq. Verafin has been using it for several years. And there it's really kind of advanced algorithms, self-learning algorithms, getting smarter and smarter and identifying patterns of behavior. And so we're able to learn from them as to how they've been able to integrate that into their product suite and into their product development suite to make it so it's more effective. At Nasdaq, we actually are asking the SEC to approve our first AI-driven order type within Nasdaq. And a big part of that is we have billions and billions of messages that flow through our systems every day. About anywhere from, I would say, 60 to 80 billion messages a day. So we have a big data pool. And what we're trying to do is structure order types that give institutional investors better fill rates. So we have a certain kind of order type called a midpoint extended life order, a little technical, but there's a timer on the order. It actually introduces latency to create a pool of liquidity that's kind of segmented within the market. And what we're trying to do is see what is the optimal timer on that order that maximizes the fill rate at that stock by stock level. And we evaluate about 175 different characteristics of the market to try to identify what is the right timer, each stock by stock, and it updates every 30 seconds. So it's a good kind of self-learning tool for the market to create a better experience for our investors. We'll see, that's just the first foray. But a big part of our strategy also is bringing our markets to the cloud. And that's a foundation, because the more you can put your capabilities into a more scalable, more resilient kind of infrastructure, and the more you can use their tooling, the smarter we can get with our technology.
Tell us about that SEC approval that you're seeking, because one of the issues is a lot of excitement about AI, some trepidation, but one of the issues is it right? Because we hear all these anecdotes about really wonderful things that are just flat wrong coming out of a generative AI. What does the SEC put you through to make sure what you're using gets it right? Because in financial transactions, you got to be right.
Yeah, I mean, I think first of all, with an order type what I just described, we're able to demonstrate how all the inputs generate an output. Right? It's a self-learning mechanism, but it's a very defined package, of AI algorithms. So we are able to show explainability of the model, and I think that's going to be a core underpinning of early AI implementation in the markets. However, when it comes to anti-financial crime, I think that's where we have to unlock the potential of the AI to help manage crime. And my view is criminals, they don't follow rules and they don't follow laws, and they're going to use the best technology available. So if they are able to use tools that are even more advanced, that may not be totally explainable, but get them to an outcome that they're looking for to take advantage of the system, I think that the banks and brokers, they have to be able to leverage those same tools to combat those criminals. And so we are asking regulators to think more broadly about how to leverage the next generation of AI, which is not as easily explainable, to be able to find patterns of behavior and root out criminal behavior. So we're hopeful that they can kind of look at use case specific ways of identifying how the guardrails should be applied.
Let's talk about financial crime, something that's very much on your mind. You've written about it just recently, actually, an op-ed piece about it. One of the things I learned from that is how big it is and how little it's detected. Give us some statistics on that.
Yeah, well, there's about $4 trillion of money that's estimated to be laundered through the financial system globally, and only about 1% of that is really caught. And so that means that it is a massive problem for the world economy. It's also, and frankly, the banks are being put on the front lines to combat this problem. And yet, so they have to have the best tooling available to do that. I think what we're challenging the regulators to think about is, number one, as I said, criminals don't just bank in one bank. In the United States, we're allowed to pool data into a third-party kind of container to allow for banks to pool the data to look for criminal behavior across the system. But in Europe, that is not allowed. In Canada, that's just starting to be allowed. And so therefore, they're really hamstrung, and they can only look at their own transactions to try to find criminals. I think that's number one. Number two, putting more AI algorithms and kind of unleashing the power of the next-gen technology to find those patterns of behavior so you can root out the criminals is number two. And then number three is a feedback loop. Regulators receive probably millions of what they call SARS reports, which are suspicion of criminal activity by the banks, but they don't ever tell the bank, yes, this was in fact a criminal act or not. If we had that feedback loop back from the regulators, we could then make the algorithms even smarter. We could say, oh, we've got validation that this was a real criminal act, so let's make sure that we can use that to kind of be smarter with the next SARS report.
So that gives me a good sense of where we are today. Where are we going? Start with Europe, first of all. Is there a real movement toward allowing some consortium data sharing to get past that problem you described?
Yeah, and that's the way to say it. It's consortium data sharing. And the answer is that there are some rules being proposed to allow for banks to start to share data within the EU and within the UK. So I think that that's a really important development. And of course, there are privacy concerns, but the fact is that there are new technologies where you can take that data in and encrypt it in a way that makes it so that you're only using the data that you need to find the right, that specific type of behavior. You're not having to expose PII from bank to bank in any way. You're basically maintaining the integrity of the privacy while still being able to leverage the right amount of data in an encrypted fashion to root out the criminals.
So if that's Europe, come back to the United States. As you said, there is some permission to have some sharing among banks here in the United States about this data. At the same time, there are issues about AI and approval of AI actually to sort out the financial crimes, as I understand it. What are the problems there?
Yeah, I mean, I think that the fact is that the banks end up putting in, as I said, so many different suspected reports of activity without that feedback loop back to say, this is real, this is not. Because the more that we can tune the engine, the better we can tune it, the more effective we're going to be. And a big part of it is reducing false positives, right? The banks have to have an army of people to look at every single pattern that is suspected, and then they have all these false positives they have to walk through. The great thing about Verafin is that we're able to reduce false positives by 25 to 50% within the banks because of the use of the consortium data and the AI algorithms. But now, even still, if we had even more of a feedback loop, we could make them even more efficient. I mean, it is unfortunately, it's still a very inefficient process.
You describe what the SEC is putting you through to get approval of your AI in a very different part of the forest.
Right.
How does that apply to financial crimes? Are you going to have to go through a similar process, and does it work as well? It's not quite as specific about inputs and outputs.
Yeah, so I would say that with regard to it's a different regulator. So it's kind of the OCC, the Fed, and others. And they actually require the banks to have complete explainability of their models. So,
Does that work?
That's an expectation that they have. We have to prove to the banks, they do diligence on us. We have to prove to them that we can prove explainability in order for them to feel comfortable using our system. And that's why I think we want to engage with the regulators to say, what's the next generation of AI you're going to do that's going to make it even more effective, and therefore maybe it's not totally explainable, but you understand that we're using it for the right purpose. And so changing the regulatory, I would say, process around the use of AI is going to be an important next step for every industry, and certainly for the financial industry. We are a data-driven industry. We are probably one of the most data-driven industries in the world. We're also kind of on the front lines of technology in many, many regards. So if they can work with us to kind of figure out how to use the technology the right way, I think it could become a blueprint for other industries.
As you seek ways to help financial institutions, other customers get their work done, part of that work right now has to do with ESG. What role can you play with respect to data, again, talking about data, when it comes to environmental, social, and governance?
Yeah, so we actually provide corporates with tools that help them manage those programs a lot more efficiently. So, corporates are having to deal with different rating agencies, taxonomies, investor expectations. There's no uniform approach to it. There's even no uniform taxonomy around it. And that's very confusing for corporates. And it's frankly very labor intensive and expensive for corporates. So what we look at as our role as an exchange operator is to really help corporates navigate the public markets more effectively and efficiently. So we've actually we bought two small companies that have built these tools to help with ESG generalized reporting, put it in one container, and then we map it to all the taxonomies and all the rating agencies that are out there. And also one that's very focused on environmental. So we have one that's more general, one that's focused on environmental, and all of the sustainability metrics that companies need to put forth. We think that makes it so that they can be more efficient and effective. And then we actually have an advisory team that helps them figure out how to communicate the right way with investors to make it so investors can give them the credit that they're owed for the programs they have. So we're not trying to take a stand on it. We're just trying to make it so that corporates can navigate it more effectively. And actually, it is the fastest growing tool within our corporate division within Nasdaq, serving corporates, because they have such a need for it.
One last one. We've talked about how Nasdaq is more than simply a stock exchange. But you still are an exchange.
We are, yes.
And you are an exchange for regulated securities. There's some news recently about regulated securities exchanges involving Coinbase. Coinbase, ironically, is actually listed on Nasdaq.
Yes, they are.
So it's one of your stocks. When something like this comes up, when there's an allegation that, in fact, they are illegally trading in regulated securities, what do you do? What does Nasdaq do with a listed company like that, where you have the SEC going after them?
Yeah, well, first of all, the way that you have to think about the process to go public, I think is probably a good starting point, which is when a company chooses to go public, they submit an enormous amount of information to the SEC. They think about their business model, their financials, and their risk factors, and all the risks and disclosures that investors need. The SEC then goes back and forth a series of questions, and once they approve it, then the exchanges are allowed to evaluate it. And the way that we evaluate it is on the basis of very discrete listing standards as well as governance standards. And we do a governance overlay. Do they have proper independence? Do they have, is the board composition appropriate for the risks that they're taking? Do they have an independent audit committee? Things like that. And then they come on. So in this particular case where you have some changes in the risk factors, I think that the question is, are they disclosing those risk factors? And that's really a job for the SEC to evaluate.
At the same time, do you have to independently take a look at it now, given the fact you're on notice?
We would actually work with FINRA and the SEC. So it's a very collaborative relationship across FINRA and the SEC in that context.
Okay, Adena, thank you so much. Really great to have you. That's Adena Friedman. She's the chair and CEO of Nasdaq.
Thank you. Thank you.
Everyone. Did you choose that walk-in music?
Yep.
Okay, yeah.
That's my theme.
Great to see you.
Nice to see you, Jason.
This is a great crowd that we have here to listen to what you have to say. I love talking to you in these contexts because you are experienced, relentlessly curious, and so well connected. And part of it stems from your network of people, but also I think it's fair to say you're sort of now not the CEO, but you were for a long time the CEO of CEOs. You have this portfolio of companies. And they give you great insights into what's happening in the world. So I want to start there. What does the world feel like right now to you as an investor?
I sort of feel today like I'm on the beach. Sunny, nice out, but I've read there's a tsunami coming or some sort of a major storm. I don't see it. But it's coming. And what we're seeing is it's a tale of two worlds in a way. The goods sector is slowing down. Inflation's starting to affect a lot of companies, not able to pass on the cost as easily as they had in the past. And then you got the services side. And the services side is doing exceptionally well. Travel, leisure, et cetera. And that's doing very well. And I don't see right now any real slowdown. Having said all of that, we do expect inflation to stay stickier overall, and in large part for several reasons. One is tight labor market, very tight labor market. That's not getting a lot better. The one thing that I guess I could be encouraged by is the participation rate from 25 to 50-year-olds has actually picked up, and I think it's over 82, 83% now. That's quite good. The 50 and over, 55 and over has really declined, and it's in the 30s, like 38%. So you're going to have a tighter labor market for longer, in my view. That's tough. Secondly, you have inflation should stay up because of the energy transition. CapEx, enormous amount of money being put into that. I think that will keep inflation up as well. And then, of course, geopolitical tensions. Our companies, and we have at any one time more or less 200 different companies around the world, they're seeing a lot of the same thing. It's business is not terrible. Revenues are up double digit. Earnings are up high single digit right now in general. And, we expect that to continue as long as we manage the cost side.
And so when you talk to these CEOs, are they nervous, excited, cautious? How would you characterize them generally?
Well, I don't know how you get very excited about inflation running where it is, and a slowdown in the economy. But having said that, yes, right now I'd say they're cautious.
Yeah.
And they're cautious on CapEx. They're cautious on expansion. Supply chain has gotten better, but it's still not perfect yet. You still have issues with China, and a lot of our companies have used China as a supply base. And so, yeah, we're just being cautious. And I think that's the right thing to do right now. Also being cautious on over-leveraging any company where we can, try to push out the maturities, et cetera.
And I would imagine that leads to a decidedly not robust deal-making market. Is that fair to say?
Pretty quiet. You know, if you think about it, Jason, today you've got a, look back at 2021, say July 2021, you had high yield, IPOs, and private credit, or credit, not private credit, at about 8.5% of GDP. Today, April, was about 1.3% of GDP. So what's happened is you have a much tighter, capital market. That just makes it tougher to do deals. Having said that, the private credit market is very strong right now, and people like KKR and others that have a large private credit business, we're able to fill the gap and do things. Secondly, we bought several companies that we just did all equity, and we'll finance later when rates come down, and we've got plenty of equity capital. We'll buy them with just equity. And so what you're going to see, I think, is a sustained period of time where the capital markets will stay tighter. It is not, to date, a credit issue. Could become a credit issue, but it's not there yet. It's more of a liquidity issue right now as to why you're not seeing as many private equity deals done.
I want to get in, based on what you just said, get into a little bit of the guts of KKR, because what you just described is a very different firm from what you and Jerry Kohlberg and your cousin George Roberts started in 1976. 95% of the money that you raised last year was not private equity. It was all in those areas that you described and more. How would you describe this firm right now?
Well, I think you have to go back a little bit and understand the most important conversation that Jerry, George, and I had in 1976, and that was, what kind of culture did we want to have? And it was very important to us to have a culture where everybody was included in everything we did. That meant that everyone was paid for and got part of the carried interest, part of the fee income, because all we did when we started was private equity. Whether you worked on a deal or you didn't, whether you were a partner at the firm or you were not a partner at the firm. Fast forward 47 years, we have 26 offices around the world, maybe 40, 45 different products that we have at KKR today, ranging all the way from every kind of credit product, infrastructure, real estate, private equity, growth equity, et cetera. And today it is exactly the same culture. Everyone at the firm gets to participate in everything we do. So that means that if I came in to see you and you're the CEO of a company, it used to be all we could talk about is your company for sale. Today, let's get to know you. We are very big believers that people do business with people they like and trust. And so build a relationship, and that's really how we go about it. And then eventually you find out, because everyone at KKR has a toolkit, they find out that, wow, this company needs to redo their balance sheet. This one wants to make an acquisition, but they don't have the banks covering them anymore because we're in a tighter credit situation, et cetera. We're able to provide capital up and down the capital structure. So yes, that is correct that last year, about 95% of the money we raised, which was somewhere in the $75–80 billion range, was non-private equity. And the reason for that was we had finished raising large private equity pools of capital already. So that money was used for climate, for ESG, for real estate, for credit, all kinds of credit, and for infrastructure. So today we're a very diversified firm, able to be a solutions provider to many companies anywhere in the world. And that's really was by design what George and I and Joe Bay and Scott Nuttall really worked on over the years.
One of the interesting things that you've gotten into, and Joe Bay, the co-CEO, talked about this a couple weeks ago or in the last week or two, was getting into the high net worth area, a new fund related to that. I mean, this has long been the holy grail, a holy grail for folks in the alternative investment business. Talk about that opportunity, if you will.
Jason, that's a huge opportunity. First of all, in the high net worth area, there's about $178 trillion of capital, net worth, income, et cetera. Today, 1% of that is in the alternative space invested. So think about that. If you just got to 3 to 5%, what does that mean? That's trillions of dollars that will be able to go into the alternative space. When I talk about alternative, what I'm saying is that's private equity, that's infrastructure, that's real estate, it's maybe private credit, et cetera. And so we have come up with democratized products across the board here. We're working with different registered advisors and getting on different platforms to sell these different products. This is fairly new for us, but initial reaction so far has been very strong. Because if we'd had this conversation 10 years ago and you said to me, do you think that KKR will ever be dealing with the high net worth population? I'd say, yeah, in a small way. But today, we're now able to deal with the high net worth population globally in a very major way. And that's going to change the complexion. These are pools of capital that will, be fairly well tied up for 5 years at least, if not longer. And we're going to, I hope, take advantage of the opportunities there today.
So one of the things that's going on at the firm, you're now a year and change, I believe, into a pretty major transition, which is your job has changed. You and George handed off the CEO roles to Scott Nuttall and Joe Bay. So what's your job like now?
Well, first of all, I'm glad after 45 years to finally get promoted. So I'm really happy about that. So George Roberts and I, we both founded the firm with Jerry Kohlberg. And for 45 years, George and I were co-CEOs. And we're now co-executive chairman. We meet officially once a week with Joe and Scott. We help them think through strategy. They're running the business. This is, given to them. And by the way, this took a lot of thought on George's and my part. We didn't wake up one night and say, okay, let's just pick some people out of the air. We actually started with about 7 people that we thought possibly could do the job. Narrowed it down to 3 people. That was over a 7-year period. And what we did then was to make Joe Bay and Scott Nuttall co-chief operating officers in, I believe, about 2017. George and I stayed as co-CEOs, and we kept giving more and more responsibility to them. Let's see how they do. And they did a phenomenal job, particularly during COVID there. The firm grew dramatically during that period of time. And they performed magnificently. They showed real leadership. Now, picking 2 people, I've heard over and over again, 2 people never work. Yes, we've got lots of examples where 2 people don't work. At KKR, George and I grew up together. We're 4 months apart in age. We met when we were 2. We're first cousins and best friends. And that's the best partnership you could have. So what we saw in Joe and Scott was the fact that they came into the firm together probably 26 years ago now, grew through the firm together, and their families are best friends. But there was one piece that we focused on very much. Obviously, they've got capability of leadership. Did they believe in and live by our culture. And that was critical, because if we lose the culture at KKR, this culture of inclusion, everybody participating, we lose our DNA. And they live by it. And so that was a very important part. George and I have always believed that if you, because we're often asked, how did you make it work so well? And by the way, you two must fight a lot. Oh yeah, we had, I think we had a terrible fight. We both were 7. And he wanted to ride my new bicycle. He had just come up to Tulsa from Houston for Christmas. I got in his new bike. And I got chased in the house because I wanted to ride the bike first. I wasn't a very good host. And I ran in the corner of a wall and cracked my head open, and I had 26 stitches. That's the last fight we've had. There's no reason to fight. Go bust your head open. So we...
Who says Wall Street isn't a contact sport? Come on.
That's right. So in Joe and Scott, we saw many of the same characteristics and same friendship and camaraderie with their families and the two of them that George and I have. And so it became pretty natural for them to then succeed us. But, you know, we built this over a long period of time because we always said we wanted a firm that survived long after George and Henry were gone, and it contained the same DNA that we've been able to build for many years in the past.
One of the things I always like to ask you about is New York City, because you've been a steward of this place since you came to Columbia Business School back in the day. You've been very involved from a civic, philanthropic, and obviously business perspective. What do you see in New York City right now? You've moved to Hudson Yards. The firm is now located there. What does New York City feel like at this moment?
You know,
Wildfires notwithstanding.
No, I worry about New York, and I think it's going to take a long time because we have something today that we didn't have before, and that's the aftermath of COVID, of just getting people back to work. Now, I'm happy to say that at KKR we got people back about 2 years ago, and what we said was we're an apprentice model. People learn from each other, so we expect you to come back in, and they did. Now, it didn't hurt in New York, for example, the fact that we had a brand new office, we had great food, and people wanted to be together, and you learn from each other. One of our biggest challenges in New York, and the challenge for Mayor Adams, is going to be to get people back into the office, and that's going to be tough. It still isn't happening yet. It's better than it was. So that's one worry. The second worry that I have is just crime. You know, I wish that the mayor and others in the government could figure out a way to be much more focused on penalties for people that commit crimes. You can go into stores and take up to $1,000 and not much happens to you, if anything. That's wrong. And so we've got to, I think, start getting tougher on crime. And it's like the broken windows theory. You know, one window gets broken, another gets broken, pretty soon the whole neighborhood's gone. Well, that's what's happened here in part. So I think this whole turnaround of New York, it can happen. I love New York. I've lived here since 1967 and coming from Oklahoma, but I think it's just going to take a long time to get back to where we should be.
All right, well, as we start to wind down a little bit, I have to ask you about a very important topic, golf. You're a very good golfer. I know that from a number of people, including my boss and your friend.
Don't believe everything you hear.
You're a deal maker. We saw a hell of a deal yesterday putting the PGA and LIV together, at least on a commercial basis. As a deal maker and a golfer, what do you make of it?
Look, I don't know all the details, and my bet is there's a lot more than what the headlines say, that the fine print is really important. But I think getting together is the best thing for golf. This fight that was going on and the lawsuits that were raging, and one side, the golfers from LIV, and you know, taking shots at the PGA and vice versa, that's not constructive for the game. You know, golf for a while was very flat years ago. Tiger Woods got into the game, and all of a sudden the number of participants in golf increased by 2-3 million participants. And then it started back down. So the worst thing, yes, it sort of makes interesting reading, but it is not constructive. So I would say this is constructive. As I say, I don't know all the fine print, the details, but I'm very happy that they've gotten this behind them. You've got some very capable people on the PGA side that are on the board there, headed by Ed Herlihy, and Jimmy Dunn's on that board. They know a lot about golf, and they're deal makers. They know how to get things done. So when I saw the headlines come across, I couldn't be happier that this is, I hope, now behind us, and we're going to be able to go forward with the game of golf. Because the game of golf is not just what you see on the TV or just the pros. It's all of us that go out on weekends and get a chance to knock the ball around.
And as you reflect on where you are, I mean, we've talked a little bit about succession. We've talked a little bit about what you're doing. What energizes you at this point from a business perspective or even personally? I mean, this is a pretty remarkable chapter that you've entered into.
Well, I happen to love where I am right now. First of all, I'm asked from time to time, so what drives me? Well, for years, what's driven me, and today it's exactly the same, if not even more so, is curiosity. I don't think that anyone can be a great investor unless you're curious. But you got to be curious about a lot of things. It's not just the stock or the stock market. If I took people to the window in our office, and we go from 74 to 80, and said, look out, what do you see out there? I hope that they would say, I see possibility, as opposed to, I see the tugboat in the Hudson River. You've got to see opportunity and see where, connect the dots. And so what drives me so much today really is curiosity. I'm spending a lot of time, which I've done since 1998, but I did it out of my back pocket, in the venture startup world. We didn't do it at KKR, so I was able to do that. Today, I built that up significantly and having a lot of fun meeting with young companies, entrepreneurs, et cetera. That's fun. Secondly, I'm very involved in an organization called Sponsors for Educational Opportunity, SEO, and that's critical for me. It's helping the underserved community get a good education from 9th grade through college, so it's an 8-year program. So I spend a lot of time on that. And I'm still very involved at KKR. In fact, I'm as busy today or busier than I've been, except I don't have to worry about all of the detail day to day.
Sounds like a pretty good job.
It's a great job.
All right. Thank you for spending time with us. Please help me thank Henry Kravis.
Thank you.
Time for a break. Stretch your legs, get a cup of coffee, but you'll be in big trouble if you're not back here at 10:40. We're starting again. Thanks so much.
Shrinking margins are driving demand for increased efficiencies on the buy side. Do you have the technology to stay ahead? Bloomberg Buy-Side Solutions cover data, analytics, trading, risk, operations. The buy side, from every side.
She told me she came so close, filled up the bathtub and put on our You know know we got it going on.
Across my beating heart.
Ladies and gentlemen, please take your seats. The program will begin in 10 minutes.
You used to do.
Ladies and gentlemen, please take your seats. The program will begin in 5 minutes. Ladies and gentlemen, please take your seats. The program is about to begin. Ladies and gentlemen, please take your seats. The program is about to begin.
Please welcome to the stage TIAA President and CEO Thasunda Brown Duckett with Bloomberg Shanali Bosick.
Thank you for joining us.
My pleasure.
There are, as you all know, a lot of long-term questions I have for you, but I figured the first place that we start, given your view of the financial health of so many Americans, how do you think about the next 6 to 12 months as they navigate this macro environment that looks to be facing a recession?
Yeah. Well, again, it's a pleasure to be here. When I think about the overall economy right now, clearly it's strong. When you look at the underlying fundamentals, we're in a strong economy, but there's some real headwinds when you think about inflation, when you think about rates continuing to rise, when you think about the broader geopolitical environment, we still are battling a war, et cetera. So what does that mean in terms of what we're seeing? We do anticipate a mild recession the latter part of the year going into the first quarter. But I think what's most important as someone who runs a company that exists to ensure millions of Americans can have a secure retirement, what we are seeing right now and what we will expect to continue to see is that 25% of Americans have reduced their contribution towards their retirement plan. And within that 25%, 50% have taken it down to zero. And so when you think about an environment where rates are so high, inflation is so high, it has real short-term, but also long-term impacts as we think about what that will mean for millions of Americans on their path to having, confidence in their retirement.
You know, it's interesting. You see a very different view when the banks think about savings and deposit rates going up. The reality, too, is you're seeing Americans not only contribute less, but dip into their retirement.
Yeah. And it's a real problem. I mean, just to kind of anchor on some key stats, there's a $4 trillion savings gap in our country. We know that 40% of Americans run out of money. We know that women retire with 30% less. And when you look at people of color, 54% of African Americans are not saving enough to retire. And so when you think about that backdrop, and when you hear stats that within that today, people are taking down their contribution and some are depleting, it will have a long-term impact that I would say we're in a crisis as we think about real risk for the average American.
It's interesting. Let's talk about the here and now, because if you look on Wall Street, people say, okay, inflation is coming down, but it's still high.
Yes.
And, actually I want to pull up a poll here to kind of talk a little bit about whether we've even seen the worst effects of them. The questions is, will there be aftershocks? Are we in the clear? Or are there new problems coming when you look at the inflationary picture for Americans?
Is that the result? I've never been in a room with
consensus.
Yeah.
No, but we'll let people
Okay,
answer a little more. I think this new problems are coming.
There we go.
It's an interesting idea here. Let alone if we're out of the woods or not. I mean, the idea that we're still in a prolonged inflationary environment. How is that impacting consumers in particular? Because Wall Street doesn't really get a view of the whole consumer picture here.
Yeah, I mean, if you just think about the everyday needs of people, how they are filling up their gas tank, the price of food, the cost of clothes, whatever that is, that impacts their overall financial picture. And so when you hear stubborn inflation is still high, we're already seeing the impact on the average consumer. To have people go into their retirement plan and reduce their contribution because they're making an impossible trade-off is a concern. And when you think about what does that mean, that means they're taking income that they're going to get taxed on. So that dollar is not a full dollar. And they're losing the compounding value over decades. So the real question for us is when people are making those tough choices today, specifically in a high inflationary environment, how do we make sure that as we're navigating through this cycle, that they can get back on track? So it's not just about the here and the now and the decision that an average American is making today. It is also about what do we do to help that average American get back on track to make sure that they can make better investment choices through the long term in order to make sure that they can have a secure retirement.
I do want to get into this idea of what companies and the government can do about this problem. But before we get there, I want to kind of outline the disparities we see here. There's this sense out there that inflation is not impacting everybody equally. Right. So what does that look like when you look at the American demographic, and what are the ripple effects of that type of widening inequality?
Well, I mean, we know, and history has told us, is that whenever we are in an environment of economic uncertainty, it can have an exacerbated impact for different populations, particularly people of color. And again, when you look at the first stat, 40% of all Americans, and then you have 54% of African Americans, and we know the impact for women retiring with 30% less. These issues compound. And one of the fundamental questions I think we all ask ourselves that are committed in wanting to close the economic gap, the inequalities, well, if we are not dealing with the long-term implications for retirement, then that debt is being transferred to their children. Those issues become compounding, which is less disposable income to put back into the economy because you're taking care of mom or dad's basic needs. So I do think it's an issue that we all have to understand and address, and understand the decisions that people are making today. How will that impact decisions tomorrow? How does that have a disproportionate impact in people of color and women? And then what decisions do we need to make in policy as well as in business to have better outcomes?
It's interesting that you put the burden transferred generationally. There are some that would also say that that burden also gets transferred to the U.S. government.
Yes.
We started today talking a lot about kind of the U.S. debt load, how unsustainable it is. How do you think about the responsibility of governments here versus corporations when you think about Americans' financial health?
Well, I don't look at it as an or, I look at it as an and. We know that good policy matters, especially when you're thinking about long-term investment solutions. And when you ask the question about Social Security, we know that Social Security was never designed to be the full replacement for someone's retirement. But the reality is, a large percentage of Americans are relying on almost 90% of Social Security to cover all of their financial needs, which is not sufficient. And so when I think about the role, I think about it in a couple dimensions. One, we need Social Security, and so hopefully we'll figure out how to address the entitlement and what does that mean. But there's real risk that it could be less. And we also know that we have longevity risk in our country. People are living longer, which will put another strain on the government. And so as we think about business, as we think about the investment community, as I think about being the CEO of TIAA, I think about how do we look at the allocation and talk about low cost in-plan annuities as part of that overall portfolio when you think about not just stocks and bonds, but you think about guaranteed income in a low cost way. I think about what employers can do to say, do we have a strong 401k or 403b plan? But it's not enough to say that we have those benefits. I think we also have to ask the question, are all of our employees participating in the plan at all levels? Are they all enrolling? And are they all increasing that percentage so that they can have confidence that they have enough coupled with Social Security and then coupled with their broader investment portfolio? So good policy matters, and I am encouraged when you think about Secure Act 1.0 and 2.0, it was bipartisan. So we need more bipartisan conversations because this is an American issue. And then we also need business to continue to make sure that the plans that we are providing for our workers are working hard for them while they're working so that they can have confidence later that they can have a secure retirement.
How much of this is a call to action for the private sector to step it up? If you're running a business, there are a lot of things you're thinking about right now.
I think it's a big question. The good news is we all know that business matters when it comes to health benefits, when it comes to retirement benefits. We understand the importance. It's not just the wages, it's also about the benefits that we provide in order to be able to attract and retain talent. And so it is a call to action. It's a call to action because we know with all the great work that business has done, it's not sufficient when the outcome is 40%. And so when I think about basic practical steps, I would suggest a few things. One, make sure that the plan is working, investing in your 401k plan or 403b plan. Auto enroll, auto escalate 1% every year to get to that maximum contribution. Clearly, the employee has the option if they need to opt out, but then next year you opt them back in. And we know studies show that when you do that, you have stronger outcomes. And then lastly, I think we cannot have this conversation without talking about education. How do we make sure that we are informing and taking the opportunity to educate our employees about the benefit, about what does it mean to have a secure retirement, and to make sure that they understand that making sure that they are secure puts a less burden on their loved ones that they care about. So there's a really important role that we play in business. And then finally, policy. I think in the business community, we have to continue to encourage Congress, to encourage the federal government to operate in a bipartisan way, to continue to provide solutions that can make it easier for the average American and easier for business to make sure that people can be on a path to a secure retirement.
You know, we started this conversation off talking about that stat that 40% of Americans run out of money.
Yep.
And if you look at the stats, the real survey here that is coming out, most people in the audience believe that there will either be aftershocks and inflation or that new problems are coming.
Yeah.
What makes that 40%, 50%, or 60% or even more? I mean, are you worried about the direction of travel here?
Yeah, I mean, I'm definitely worried, but I also have optimism because we're in for the fight. You know, we are committed to making sure that we can do our part to improve the outcome. But when you look at these stats, you have to be concerned. Because if we continue to have a high inflationary period, if everything continues to cost more, if wages are not keeping up with the cost in the rise of inflation, then the average person has to make decisions for the short term that can have longer term implications. And so I think it's important for us to continue to make sure that we're looking at the after potential effects of inflation. I think we absolutely have to make sure we're not just thinking about the here and now, but what are people doing and what are those behaviors that people are acting today, and what can that mean in the long term? Because we will have a crisis in our country if we are not making better decisions today to make sure that people can have all the solutions and the tools that they need to retire.
I want to talk a little more about some of the hot button issues in the market as well, because I know that you have a pretty nuanced takes to them. We've been talking so much. Everyone's going to be talking about artificial intelligence today, let's be honest. But you know, when you think about how you're running your business on it, TIAA is a private company, what are the ways you're using it, and what are the ways you're most concerned?
I mean, AI has been here. It's here, and it's only going to continue to grow in terms of what it means to business. The way I think about it is I think the way that many of us think about it, clearly the benefits of AI is improved productivity. There's opportunities to make it easier to delight the client experience. There's ways to be the companion to the employees that you have so that some of the baseline work can be not what they have to focus on, so they can work on, higher complex issues, and making sure that you have a reskilling program in place as you think about the jobs of tomorrow. But I also think, given that we are a long-term investor, and given that we are working with participants all ages, all the way through the transfer of wealth, we have to be concerned about risk. And so I think as we continue to invest in technology, as we all continue to get smarter about AI, I think it has to run a parallel path to really running what are all the risk scenarios. I think the investments that we make in technology, whether it's cyber or other risk tools, cannot just be the protection of yesterday's risks. It's not even enough to make sure that you're investing for the today's risk. We are making investments to thinking about tomorrow. What are the implications of ChatGPT? What are the implications in terms of account takeover? What are the implications in terms of imposters coming in and they sound like your daughter, they know your behavior, and then they're taking your money? So I think there are real risks that we have to make sure that we're focused on, while we also are taking advantage of what the advantages of this technology can mean in terms of the company that, that I run.
How often is some of that actually happening right now?
I mean, it's here. I mean, cyber risk is a real risk. When you think about fraud, when you think about people wanting to take advantage of the elderly community is one of the sectors that are most prime for abuse. And so making sure that we're communicating with our participants, making sure we're communicating with their loved ones. This is a risk that's happening today. And the risk will only become more amplified as we think about the sophistication of technology. And so that is why I think it's important that when we're having the conversation about AI or any technology, especially in the investment community, at the same time, we have to have the conversation about risk to make sure that we are doing both, taking advantage of what can be good for business, but it's not good if it's not protecting ultimately who we serve. And so we have to strike the balance.
Do you think that many companies are kind of being very naive to some of those risks on the surface?
I don't. I mean, whether it's the Business Council, the Business Roundtable, I mean, any environment that I'm in talking with other colleagues, this is top of mind. And it's top of mind with respect to innovation. It's top of mind with respect to what does it mean to the workplace and the workforce. And it's top of mind for all of us as we think about the different risks that it can mean to our business. So I do think that we're not being naive. I think we want to become more knowledgeable about the use cases across our company. But I think any good leader wants to also understand, how do I make sure that I'm also protecting the company and the people that we serve?
We started this conversation talking about this idea of a mild recession on the horizon. How would you help the audience here anchor their minds into what are the things that investors are not seeing, the biggest risks that you're thinking about right now as we think through the next 6 to 12 months?
I mean, the good news, I think we're all talking about the same thing. And I think investors are looking at the macro environment, but I also think investors are looking at what does it mean to the balance sheet of everyday Americans, or regardless, in terms of all the decisions that we have to make. I think when we look at a mild recession, I mean, clearly the labor market continues to be strong. I think clearly unemployment continues to be low. So I think the piece that we're trying to all reconcile is, how can you continue to have a strong labor market, lower employment, and be able to bring down inflation at the same time? I think clearly some of the nuances that I know we're all talking about is there's different sectors that are being impacted, whether it's commercial real estate. I think there's a question about credit. Will credit tighten? And if credit tightens, what implications will that have as we think about investment options? But I think the core fundamentals are continuing to be strong. I think we all understand what's happening in the environment. But I do think these unknowns are ones that we're going to have to continue to navigate. And I think the most important thing that I would share, given the space that I'm in, is making sure that as we think about the long term, particularly for those when you're thinking about their allocation for retirement, are we doing everything that we can to make sure that within their portfolio they have access and exposure to guaranteed income?
And into a potential recession, this idea that Americans are dipping into their savings to get through the cycle, is the consumer as strong as everybody thinks?
Yeah, I mean, it's uneven. I think, on one hand, people are sitting with a lot of cash on the sideline. And on the other hand, there's everyday Americans that are making, real tough decisions on how to access cash. And so I think we cannot just look at the macro numbers. I think we have to recognize that it's uneven. And I think as we're navigating this environment, there will continue to be stress on that average consumer. And depending on what happens in a prolonged potential recession, those implications can be exacerbated. And I think that's something we have to continue to watch.
Shonda, thank you so much.
Thank you very much.
For
Thank
your
you.
time.
Please welcome to the stage Soros Fund Management CEO and Chief Investment Officer Dawn Fitzpatrick with Bloomberg's Eric Schatzker.
Dawn, good morning.
Good morning.
Morning, everyone. Boy, I think the best place for us to start, Dawn, is by giving everybody a little bit of context, because the more they understand about you and the more they understand the nature of Soros Fund Management as an organization, the better they'll understand and appreciate how you look at the world and the importance or not of the things that you say. I think of your job as pretty unique, right? You have a lot of freedom. You can be highly opportunistic. You can be utterly unconstrained in the investment decisions that you make. Highly unusual for a pool of capital as large as yours, right? In the order of $30 billion?
Just shy of that.
Just shy. It enables you to respond immediately and to pounce on market dislocations. And as I understand it, that's why you're always studying, right, the market for potential cause and effect scenarios. Is that right?
That's right. We have a really open investment mandate. So we have one team, one pool of capital, really one sophisticated client. So we can move across asset classes, across liquidity in ways that I think very few other pools of capital can do. And we have a very integrated team, so we can connect a lot of dots that I think are harder for others. And in a moment in time like this, I think that becomes exponentially more valuable.
And just to avoid any confusion, that client is George.
and his foundations.
I do want to spend a good part of our conversation talking about these scenarios, the ones that you see unfolding in the near term and maybe a little bit further out. So what excites you most right now? What are you most interested in? What do you see happening?
So right now, the asset class that we think is most interesting is actually typically a boring asset class, and that's agency mortgage-backed securities. And the reason for that is 2/3 about of your current holders, it's the central bank and banks have turned sellers. And you have a dynamic where you've had extraordinary interest rate volatility. So the valuations in that space have gotten, we would say, disproportionately cheap relative to other asset classes because of those technicals. Mm-hmm. And also you had obviously some high profile regional bank failures where you have the FDIC auctioning off a good portion or sizable portfolios. And that's also adding to kind of the technical backdrop. But we think that asset class is probably uniquely interesting right now.
You're not the only person to say that RMBS looks attractive, or agency, mortgage bonds look attractive. How long can that last? I mean, if everybody sees the value in that trade, surely, right, the spread has to collapse.
Yeah, well, a couple things. First of all, when it comes to equities, I hate being in a consensus trade because you're at the mercy of the next, the greater fool or the next marginal buyer. When you buy fixed income, you just have to be right because eventually you have a maturity. So I think you're right. There's a lot of people who are citing this asset class as cheap. When something's cheap, I want to know why it's cheap. And again, there's some really clear technical reasons why this asset class is cheap. And by the way, I think you're going to see more bank failures, likely in the small banks. So it's not going to be the big headlines and the size of the failures we had so far. But I think there's more problems under the surface. So you'll see continued sales. And the other thing that is undeniable is in aggregate, banks have to reduce balance sheets and shorten duration of portfolios here. There is, regulation coming that's going to be pretty punitive.
Talk a bit more about that.
Yeah, so I think, the Federal Reserve has said they're doing a comprehensive review of bank regulation. I think what that's going to look like is enhanced stress test. AOIC exemptions, I think, are going to disappear. That's where people didn't have to mark things to market. I think when it comes to liquidity management, there's going to be a lot more scrutiny on that. One of the interesting things is coming out of the financial crisis, there was a lot of focus on asset quality, so things like stress tests, and not as much on liability management. But now we know, deposit assumptions were just wrong. And by the way, I won't mention the name, but a bank yesterday said they lost one of their biggest depositors because another bank was paying Fed funds plus 70 basis points for deposits. That's not a healthy backdrop. And by the way, part of the reason they can do that is because you have a quasi-government guarantee right now on bank deposits.
So in addition to agency mortgage bonds, what other kinds of trades and or investments seem attractive to you with that as the backdrop?
So we're finally, with that as the backdrop, you are seeing a credit contraction. I think, the recent loan data, doesn't actually surprise a little bit better to the upside, but this contraction is invariably coming. Banks will just be able to loan less. In the levered loan space, 70% of levered loans have been bought recently by CLOs. CLO issuance right now is at 2020 levels. And also, typically, CLOs have a reset where they can extend duration. But this is another unintended consequences of higher rates. Now, with higher rates, those resets don't make economic sense. So you have 40% of existing CLOs ending their reinvestment periods by the end of this year. So you're just going to have less credit available. And there's a lot of people who think, private credit has grown exponentially. They'll just fill in the gap. I think that's not going to prove to be quite accurate. They can do more than they could have done 10 years ago, but it's too big a gap to fill in. So in private credit, we're finally seeing things begin to reprice. And I think you are going to see a default cycle that is about to kind of emerge. And I think the magnitude and probably more interesting, the duration of that default cycle is going to surprise people.
How do we see that play out then? There's clearly a bond market, there's a leveraged loan market, but there isn't much of a secondary market for things like the unitranche loans that have been, that lately have been dominating the growth of the private credit market.
Yeah, so again, I think private credit firms are all opportunistically trying to raise capital. I think when you look at alternative asset management capital raises, they're generally challenged. Maybe private credit is a little less challenged than other areas, but they're all challenged. I think in the private credit world, one of the things you're going to see is the most vulnerable loans are going to be the ones that private equity took out, so sponsor loans. And I think you're going to see those private equity companies be really aggressive around liquidity and maturity issues. So I think you're going to see a lot of kind of extend and pretend. And that also reduces the amount of real dry powder out there.
For you, is this just a matter of waiting for the things that you find interesting to get cheap enough? Or are there opportunities to short along the way?
Yeah, so right now our balance sheet is really clean. And one of the things I've been stressing to the team is it is a little bit about being patient. And I think sometimes that's something that investors do poorly, both institutional and retail, is just be patient and let the opportunity set come to you. I think where we're headed, in some ways, the great financial crisis and COVID were not that painful, right? Because they were really deep corrections. and really quick recoveries, I think this is set up for something that's going to take a really long time to play through. I think there's a lot of private equity and borrowers and people who own big buildings who are betting rates come down quickly, and that I don't see that happening.
Do you not see it happening with enough conviction that you're willing to take the other side of the rate trade?
We have that bet on in rates for sure, and I think one of the things that's different about this time is you had central banks and fiscal authorities throw everything, their entire financial crisis playbook, plus $6 trillion at the pandemic recession. In hindsight, it was too much, and it caused just overly abundant credit and asset inflation. And the workout on the other side is just going to take a really long time. And what we see is you still have a lot of underlying distortions. So like within sectors, you have like boom bust cycles. So at the surface, things look good, but below the surface, like all hell is breaking out. But think about that. That's going to make the Fed's job really, really difficult. And you could have a really big default cycle without GDP rolling over.
Much of this, Don, as you just alluded, is the consequence of policymaking, both at the fiscal and monetary level. How much confidence do you have in market regulation right now? When you see what's going on in crypto, for example, over the past couple of days, and folks, I think you're going to hear a little more about that in a few minutes, but also in antitrust.
Yep.
You mentioned banking.
Yeah, so I will start with crypto, which always gets me into trouble. But but I think, you know, especially the headlines of the last couple of days, it's clear these crypto native platforms would have benefited from having an adult in the room.
Somebody might have something to say about that.
To state the obvious, but like there are just long held and simple norms about how you treat customer assets, for example. And what I think crypto is here to stay. I think what's happened is clearly a setback. But right now, I actually think it's a huge opportunity for the incumbent financial firms to actually take the lead.
The ones that are already regulated and run, for example, regulated exchanges.
Yeah, and know how to segregate client assets and yeah. So I think that is what's going to happen. On kind
Wouldn't that be ironic, though, given the disruption that crypto promised?
Yeah, there is some irony to it, and I'm yeah, it is ironic, but I think that is going to be the evolution. In terms of hedge funds and private equity, you know, when I look like at the Financial Stability Oversight Committee, which sits on top of all of the U.S. kind of regulatory apparatus, which our U.S. regulatory setup is really too fractured to be wholly effective, in my opinion. But when you look at what they're focused on, it's clear that they know post the financial crisis, because of regulation, they shifted an exponential amount of risk into the non-regulated, non-banking sector. And they're trying to figure out ways to get out that, because that is where your next systemic risk is going to occur. And their ability to spot it and course correct right now, I think, is pretty limited. So you see things coming out like the amendment to Form PF.
Mm-hmm. Where they have to alert the SEC to so-called trigger events?
Yeah, in very short duration. I actually think...
72 hours, I think.
Exactly. And I think in a lot of ways, that design is better than in 2011, Form PF just asked for this huge data dump that candidly, I'm not sure the SEC knew what to do with. So this alert system, I think, is really interesting and like elegant in its simplicity. But I worry it will allow them to see idiosyncratic risks and probably help those. But when it comes to systemic events, I think they might see it, but they're going to see it too late.
So, a systemic event of what nature? That the highly levered multi-strategy hedge fund, all of a sudden has serious problems?
Yeah, so if you look at the top 4 public market hedge funds right now, their balance sheets, their gross assets are well in excess of $1 trillion. And again, you have your regulated dealer community where the balance sheets have done nothing but go down. Another stat that's really interesting, your publicly traded alts, assets under management, have doubled since 2020. So in other words, and I would argue those big multi-strategy platforms, they don't do things that are all that different from one another. So when you have an unwind of a trade, finding that marginal buyer, I think is just going to be that much more difficult. It's one of the things at Soros Fund Management we think about every day, in that we think we want to position ourselves to take advantage of those dislocations. But by the way, you saw it on the back of Silicon Valley Bank failure when you had 2-year treasury rates go from above 5% to below 360. That's like a crazy, enormous move for a 2-year government bond.
There are any number of different kinds of dislocations. We've talked about some of them: technical, structural, cyclical. There's technological too. Yep. Do you think AI is going to create market disruptions, dislocations?
Potentially. I think, when we see what's going on in AI, first of all, when you look at what just came out of the recent earnings report, it is clear that we're at the beginning of a mega cycle in spending in AI. And the real beneficiaries, obviously, are the applications, so your SaaS companies, and infrastructure, so it's cloud and your high performing chip companies. Those stocks right now are extrapolating pretty enormous compounding growth. We wouldn't necessarily chase that, but to your point, what's really striking about where we are right now is AI allows us to talk to computers like ourselves, and the ability to tap into massive compute power, and probably even more importantly, enterprise data and just global data generally, is going to be seismic, and the capabilities are just going to be exponential.
Don, last question for you. There's a long tradition of prominent investors who speak out about economic policy. And much of the commentary we get from them, I think, is genuinely altruistic, right? Out of concern for the good of the country, or perhaps even the good of the world. And George Soros is near or at the top of that list. Also Stan Druckenmiller, who was here earlier, who once held the role that you hold now. Ray Dalio, Ken Griffin, on occasion. We get it from Warren Buffett, Bill Ackman, Paul Tudor Jones, whom you know well. They're all men. I'd love to add a woman to that list. Will it be Don Fitzpatrick?
Hopefully one day. Yeah, George is active, and I think it's important that I'm deferential to him. I do serve on government advisory committees, so I try to be
working behind the scenes.
I try to work behind the scenes, but yeah, one day.
Ladies and gentlemen, please join me in thanking Don Fitzpatrick.
Please welcome to the stage NIAM Investment Office Chief Investment Officer, Dr. Manar Al-Monif with Bloomberg's Michelle Lin.
Hi there. I'm Michelle Lin, Global Head of Data Science and Insight for the Bloomberg Media Organization, and I'm joined by Dr. Manar Al-Monif, Chief Investment Officer at NIAM Investment Office, joining us for the NIAM Sponsor Spotlight, Redefining Sustainability, Livability, and Business among current global challenges. Welcome to Bloomberg Invest, Dr. Minar.
Good morning, and thank you so much for having me here.
Okay, so we want to start out by just saying many of us have heard a lot about the vertical city of the line at NEOM, but I understand that NEOM is much more. Can you provide us with a brief overview and tell us why NEOM and why now?
That's great. Well, I think so we can agree on one thing, that we're all trying to do our best to create a better life. And I'll answer your question. The first one is why NEOM? Well, simply when NEOM was created, it wasn't only to create a better life for Saudi Arabia. It was simply built as a foundation of a living laboratory where you can create new ideas, new innovation, to create a more sustainable future for all of us, and these ideas that can be exported around the world. And NEOM was built on three main pillars as a global opportunity for everyone. The first one is to redefine sustainability by not only focusing on 100% renewable energy, but how can you build a more circular economy to go toward a net zero carbon society? That's our aim. Today, it's built on 100% renewable energy, but we're pushing the limits even to go beyond that. The second pillar that we're focusing on is redefining livability by actually building a city centered around people, bringing time back to them, and ensuring that we're creating an exceptional high quality of life, giving time back to people, and offering for them diverse, interconnected communities, access to exceptional landscaping available, and most importantly, bringing time back to them. And the third aspect or pillar that we focus on is redefining businesses. Our aim is for NEOM businesses to grow faster than anywhere else around the world by creating a foundation of an infrastructure free from any legacy infrastructure, progressive laws and regulation that is primarily focused on businesses to allow them to grow faster than anywhere else around the world. So that's really the main pillar that we're focusing on, and that's the foundation that we're presenting to the globe today.
So where is NEOM now in its development?
Great question. There is a lot of development. I think so today when you speak about the word NEOM, everyone is speaking about it in details. Significant work have taken place in NEOM. Today, example, we've done 20% of the essential infrastructure is already in place. The amount of construction work that's taking place in NEOM is exceptional at a speed that's never been done before anywhere else around the world. We've launched 4 regions so far, and that is true to our vision in which we're developing only 5% of the land in NEOM, and 95% is going to be untouched by urbanization. This is the line, the vertical city, which is a true transformation when it comes to livability. Sindala, which is our islands that's connected to the Red Sea. Trojena, a year-round mountain destination. And finally, Oxagon, which is an industrial city that is changing the way that we're doing business. It's a place where you can have Fortune 500 companies, startups working together to introduce the latest innovations and technology that will help us to introduce the future business and development. Another development is we've achieved financial close to the largest green hydrogen plant that will be producing 600 tons of hydrogen on a daily basis that can be used in NEOM and exported majority globally. And that's one of many to come. And the exciting news is we had really significant interest from the market. 23 financial institutions participated in the close of the green hydrogen.
So how do you navigate today's market dynamics, and what do you see for the future?
No one can predict the market dynamics. You have your ups, you have your downs. Every day comes with a different challenge that you see. But as an example, Saudi Arabia Vision 2030, when it was launched back in 2016, primary focus was diversification. At that time, the oil prices was $30 a barrel. Today it's 70. And we're proceeding with a speed that's never been seen before in making this transformation and change. And as a Saudi, I'm really impressed and very proud with the speed of how things are happening. Saudi Arabia, world capital of energy, didn't used to speak about renewable energy. Today they're taking the lead in speaking about green hydrogen and new development. So today it's clear for us, we're building a sustainable city We're building a future. And today we're extending an invitation to everyone that is as keen as we are in building a more sustainable future to join us in this journey and building something sustainable for the long term, for us and for generations to come.
Thank you, Dr. Manar, for joining me today for NEOM's Sponsor Spotlight and for discussing redefining sustainability, livability, and business among global, current global challenges.
Thank you so much for having me.
Please welcome to the stage 6th Street Vice Chairman and Partner Marty Chavez and 2 Sigma co-founder and co-chairman David Siegel with Bloomberg's Katie Greifeld.
All right, hello everyone. Thank you for joining us today. My name is Katie Greifeld. I'm an anchor with Bloomberg News. I'm joined here by Marty and David, who really need no introduction. So we're talking about the future of finance as it relates to AI. You two are uniquely qualified to talk about this. Just to go through some of your background here, Marty, in addition to a PhD in medical information sciences, you have a computer science degree from Harvard. David, you one up that a little bit. You have a PhD in computer science. I have a liberal arts degree, which is also very good, but I guess a good place to start, it feels like the hype around AI gets bigger by the day, and on some days bigger by the hour. So let's focus this conversation on the investing landscape and set the scene here. When it comes to specifically investing, David, what is hype and what is reality? How big could the reality actually get?
The hype is absolutely remarkable, and I've never seen anything quite like it. ChatGPT really captured people's imagination, and in a way that surprised absolutely everyone.
More than pets.com?
Or diapers.com. Exactly. What I think people don't recognize widely is that AI has been having an impact for decades, and this stuff isn't brand new. The applications that you're seeing today have been in the works for quite some time, and in various applications, you've been interacting with essentially language models. You've been interacting with deep learning. You've been interacting with all sorts of AI approaches. So what's really changed is that the awareness has occurred. There have been some recent advances that have been created by scale-ups, creating ever larger models, which have displayed properties and behaviors that are very interesting, unexpected in some cases. I think everyone in the research world, everyone is pretty surprised at the behaviors that are emerging from large language models. That's actually really, really interesting. Some people have claimed it's sentient, and then when they say that, they get into trouble. I certainly don't think that it's sentient. But I could talk a lot about this, but I'll pause. But the one thing that I wanted to, it's almost like a joke. When I was at the AI lab at MIT, back in the 80s, late 80s, the joke was whenever AI, the definition of AI that we used was something that you could not achieve in a computer. So anytime that you actually got a program to do it, and everyone would say, that's not AI, it's just a piece of software. And so that actually, it's not really a joke. When I look at many of these things today, I say, okay, it's really cool, it's unbelievably impressive, it's very useful, but this has just been a progression. You could say that about computers in general. And the impact of computers on society, the impact of databases on society, this has been going on for since the beginning, since when computers were invented. And so I see this as a progression. It's extremely exciting, but I'm not actually buying into the hype to the extent that you might. I mean, it's amazing how many times this stuff is on the front page of the New York Times.
Right.
It's just absolutely. And by the way, if you go back long ago and you looked at, for example, ELIZA, which was the first chat program that was invented at MIT in the 70s. Even that actually, I think, made the front page of the New York Times. I don't know if any of you are aware of it, but it was a pretty simple program, but it was an ability for someone to it was a chat bot, and it turns out that many people became seduced by it and would sit there chatting away with it, just like they do with ChatGPT, and they were like, "I can't believe the computer can do this." And
it was a few hundred lines of Lisp.
It was a few hundred lines of code.
Right.
And so some of what's going on today with AI is that people are reading a little bit too much into these things. Just they want to believe that this thing is maybe sentient, right? And so what we're seeing is actually a very interesting experiment in human psychology.
So there's a lot there. Let's pick up on that point that David made, though, that this is a progression of what we've seen for a long time. I mean, AI has been around in investing for a long time. And when you think about the current buzz right now over generative AI, what we're seeing with chatbots, ChatGPT, do you see that as a progression of basically the AI evolution in investing, or is this a breakthrough?
So it's just more software. That's how I would see it. And we've been bringing more software into finance for a really long time. And there's been all kinds of breakthroughs, and there's been all kinds of problems. It is statistical pattern matching. It's extremely powerful, and it's interesting. But I do not see AI achieving what some would call the Holy Grail. Everybody wants to know, what's the S&P going to be in 6 months?
Can you tell me?
And I can't.
Okay.
And neither can the AIs. And at the risk of getting too technical, there's a really profound technical reason why the AIs, I think, are not going to do that, predict the stock market. The successes that we've seen in AI, and they are amazing, they are brilliant, all come from one profound realization, which is if you can take a large number of samples and you can dichotomize it and say, these are pictures of cats and these are not pictures of cats. And it turns out the internet was great for that because people love putting pictures of their cats on the internet, and they say, this is my cat.
Yeah.
So now you've got this labeled data set.
Yeah.
Well, we've gone to town on that. You can train up an AI, and it can say, you give it a new image it hasn't seen before, and it'll tell you whether there's a cat or not, and then it'll tell you all the variations. It will tell you, this cat is 10 years old, and it's this breed, and it might be sick with this kind of disease. It's just gotten better and better at that. But that is because the concept of a cat is stable in time.
Cats aren't evolving.
Well, they evolve, but
Right.
very slowly in evolutionary time, not from today to tomorrow. The stock market is notoriously not a stable distribution. So,
Well, it's taken a lot of guesswork out of my life trying to decide what is a cat and what is not. But somehow I see we only have 9 minutes left. So I want to talk a little bit about applications because to your point, your view is that AI isn't going to tell us where the S&P 500 is going to go. But when you think about sort of the biggest opportunity for application of AI in investing, I mean, David, is it actually boosting returns or is it just boosting productivity when it comes to the research side?
Well, in a sense that if we were having this conversation years ago, you could say, you could replace AI with regression. And you could say, how is regression and clever uses of regression or boosted learning or any of these things? And, not to brush aside your question, the answer is, but the answer is it's actually kind of hard to tell. It is a relatively, large language models are relatively new, and people are now trying to think of what are the most effective ways of using them. And we have such limited time. I don't want to talk about a deep dive or talk about things that people may know. But for example, large language models are pretty good at taking text and summarizing it. The summaries may not be all that reliable, but they can summarize things. And so that can be a boost to humans if you need a summary. And to be clear, large language models, you all know, they hallucinate, they give inaccurate information, so they can't really be used for a problem where you definitely have to get the right answer. So, if you want to, diagnose a health condition that you have, sure, you can type it into ChatGPT and you're going to get an answer. But, of course, not to believe it. You might use that as a starting point. Yes. So for applications where you don't need exactly the right answer, or it's okay that it could be completely wrong, and there are many applications like that, it'll be very useful. But just like with every other tool that's been invented, time will tell.
Well, Marty, come in on that, because we were talking about whether there's going to be 5 large language models or whether there's going to be 5 billion. And I'm curious to hear your answer to that, and also what the implications of that is.
So you would think, especially in finance, that we could make a tighter market than 5 at 5 billion. But really, as far as I can tell, nobody knows the answer. Are there going to be a small number of hyperscalers, Amazon, Google, so on, that concentrate these services? Because among other things, to train one of these frontier large language models requires clusters that are doing 25 exaflops. That's 25 times 10 to the 18 instructions per second, and they have to do that for months. And so that would argue for there being a very small number. On the other hand, there's been this notable release into open software of an LLM that Meta was working on, and now there's thousands of versions of them. I can't keep track. And the question is whether for specific applications will those be good enough, and then there will be 1 million or 1 billion flowers blooming. But back to your question on returns, I would say it's good for net returns.
Okay.
Right? So I don't know about gross returns, but it's definitely going to increase productivity. And there's a lot of agony about what it's going to do to investing jobs. There's one thing that I've experienced, I know David has experienced this too, which is over time, there's just more and more people working in our industry. But the skill sets have changed in a dramatic way. And what those people are doing is very different. So yelling buy and sell into a phone isn't really happening because the computers are doing that much faster. But there's still a lot of people. We have traders who code. And so I would give the same advice that I gave in a somewhat infamous town hall at Goldman Sachs in 2011, where I said there's really 3 stable strategies with respect to the computers, and I'd say this is true for AI as well. You can be a person who tells them what to do, and that's worked well for me. You can be a person who collaborates with computers and the people who tell the computers what to do. That's a great strategy for everybody. You can stand in the way of progress and hope that you keep your job forever doing exactly what you're doing, and that is really dumb, and you will be roadkill.
I think we all know some people like that.
You gotta get with it. So one of the things that I'm super excited about, just to say one last thing, is on David's point of summarizing docs, I'm actually pretty optimistic that generative AI is going to get more aligned and more constrained and more grounded in reality. So you'll be able to do cool things like, here's my 1,000-page limited partner agreement. Can you summarize it for me? And actually, can you give that to me in the form of a sonnet or a haiku?
Yeah. By the way, but I've of course done many experiments with various large language models, and I recently asked ChatGPT, I believe I was using that one, a legal question that I had, and it was question doesn't really matter, and it gave me a very well-reasoned answer, and I was quite impressed, and it was like a couple of pages long, and it cited various laws, and it reached various conclusions, and it was super impressive until I tried to validate it, and it turns out that everything it said only had a grain of truth, and so the whole thing was entirely wrong, but it was incredibly impressive. And so, you've all heard about hallucinations, but, try it yourself. And what you're going to see is that for certain classes of problems where the training data is of high quality and it doesn't have to do kind of, deep inferencing, it's actually pretty good. But when it has to make, let's just call it conjectures, connecting things together that have less statistical oomph, it falls apart pretty quickly. And one of the reasons I actually philanthropically fund basic research in AI is that to really make progress in the field, in my opinion, it's not just about, for example, taking LLMs, the current state-of-the-art models that are being used, and making them bigger and bigger. We need to have a deeper understanding of why they're working, how they're working, where the limitations are, and that will guide the research that will be needed. And so I still consider this whole thing there are definitely commercial applications. This is going to be big impact. There's a lot of money to be made off of what we've got today, but it's the early days. And this is not in any way a solved problem.
R&D.
R&D. So we should all invest in R&D.
Well, I'm being a bad moderator because we do have a poll. We have about 2 minutes left. So the poll is that some AI leaders are warning about a risk of extinction, sort of what we were talking about. Your options are that they are right, I'm prepping my bunker, hypothetical risks distract us from practical concerns, or I'm not worrying about AI at all. Just 6% aren't worried at 5%. Geez, 8%. Okay, so people are voting in real time. That's pretty cool. What are your thoughts? When you think about the risks, what is your anxiety level right now, would you say?
My anxiety level is medium.
Okay.
I am anxious generally. I've been working like David in various kinds of electronic trading for a big part of my career, and I can think of ways in which this can go terribly wrong. But we've had those problems before, right? So if you're connecting up an AI to an exchange and there's no breaks, like checking that you're a good credit counterparty before this trade goes in, I worry about things like that. So I'm big advocate for those control points where AIs interact with the outside world, having an awful lot of safety checks. But this is old. We've done this with railroads. We've done this with we've done this with electronic trading.
We've been here before.
That is super important, and we absolutely have to get that right. The existential risks, I don't lie awake thinking about them. How about you, David?
Fully agree. I worry about an awful lot of stuff, and there are an incredible number of things that can go haywire in our world. There are an incredible number of technologies, CRISPR, for example, that could cause things to go haywire. But what you tend to find is that the good news is society doesn't want everything to go haywire. And so there's a countervailing force where people somehow figure out how to avoid extinction. And so I'm not particularly worried about AI any more than 50 other things.
That's a good place to end it. Marty, David, this was awesome. Thank you both so much.
It's a pleasure.
Thank you.
Please welcome to the stage WNBA Commissioner Catherine Engelbert with Bloomberg's Scarlet Fu.
Hi, everyone. Thank you so much for joining us for this conversation with Cathy Engelbert, the first commissioner of the WNBA. Our session is called Leveling the Playing Field in Women's Sports, and obviously there is a ton of excitement around women's sports and investing in women's sports right now. I'm curious, from where you sit, for the WNBA, 2022 was a banner year. What is the single best number that effectively tells that story?
Oh, Scarlett, first of all, it's great to be here back at Bloomberg. I would say most viewed season in 20 years, and we're only 26 years old. We just tipped off our 27th season, so, but there's lots of others, 1 billion impressions on social media, all the stuff you read about. But yeah, the viewership, because that's so important in building the economic model for the long term.
Absolutely. So there's a lot of demand, and we know that the WNBA currently has 12 teams, but you've said that that's not enough for a country of 300 million. Players want more teams, fans want more teams. The timeline for adding new teams right now is, what, 2025-ish? Why not sooner?
Yeah, we hope to add to, we hope it's an aggressive timeline to add to by 25. You have to run an expansion draft. Obviously, got to have arena leases. You have to have practice facilities. This year, there's a lot of discussion around roster spots because a lot of second-round picks don't make teams. One first-round pick didn't make a team. So you also don't want to degrade the quality of the game. So as you think about expanding into markets, like you said, I said, there's 330 million people in this country. We're the longest tenured women's professional sports team in the country at just tipping off 27, double any other. No one else has reached 12. So we've got a lead on this, and we've got, but when I came into the league, we had a lot of transformation to do, Scarlett. I mean, we didn't have enough fans. We didn't have enough national platform broadcasts. We hadn't globalized the game. I had one marketing person when I walked in, and now we have over 20. So it's something where you've got to build, you have to scale, and ultimately expansion had always been on my list. But we didn't want to rush into it because we wanted new owners, like new ownership groups. Anyone who knows sports here knows, like, it's a slog to be a sports owner and to make money. You just walk into the back of house of any arena or stadium and you figure out how expensive it is to put on a game. And so we're on the path to transform the entire organization, both teams and we just had a capital raise of 2 of our teams, Seattle and Chicago, at pretty good valuations for us. So that's like getting us on a good path now.
You said the word transform because I've heard you talk about the need to transform the economics, the business model before aggressively pursuing expansion of the league. What specific part of the model do you think needs to evolve to meet the needs of 2023?
Well, first of all, the first thing I came in after a long career, 33 years at Deloitte, and I come into the league, and the first stat someone gave me is less than 1% of all corporate sponsorship dollars go towards women's sports, and less than 5% of all media coverage of sports covers women's sports. So, of course, as a good former accountant, I say, well, what's the denominator? I said, is the denominator $1 billion, 30 billion, 100 billion? Because if you were going to move that even a couple hundred basis points, let alone get it to parity, equity, or whatever word you want to use, how hard is this going to be? And little did I know, the denominator is huge. Just in North America, I think media rights deals are 30 to 40 billion for kind of U.S. and Canadian-based teams, and obviously globally it's much bigger. So even to move it 200 basis points is going to be Herculean. We're doing that. But that's what, funds all the things that get higher pay and better travel conditions and everything for men's sports is media rights deals. Period. So as we look at the transformation, that's on the list, marketing's on the list, underinvestment and undervaluation of women in sports. I think we're a little bit of a microcosm of broader society, although I saw that the statistics now on women CEOs is up for the first time over a little over 10%, so that's progress. So, we're trying to do the same thing around sports. Sports is just a little behind the corporate world from that perspective.
Well, one thing that when you talk about the WNBA, it started league play in 1997, and at that time it was a huge draw, right? Like ratings bonanza, expanded aggressively, but by 2000 the tide kind of turned a little bit. Attendance declined, TV ratings dropped, and sponsors stopped renewing contracts because the games weren't drawing enough viewers, particularly men. What are the lessons from that fallow period? How do you safeguard that from happening again?
I think the lessons are around data now. I walked in and I said to the league, and I said, who are our fans? And I kind of got looked at kind of funny. Like, you have to have a ton of data to determine who your fans are. Do we skew more women? Do we skew more girl dads? Does a fan in Miami, where we don't have a team, buy a New York Liberty jersey, and does that make them a New York fan? And are we marketing to them and using data and technology? And we were doing none of that. So I think that's the lesson now, is to find out who that fan is, who that potential fan is. I mean, sports betting now is legal in how many states here in the U.S., and we never had a focus on grabbing that fan in a watch and bet versus a bet and watch, because so much of sports betting now happens in the game. So there's things you can do globally, globalization. I mean, we hadn't globalized it all, and I admire actually what the NBA has done with their global games platform. And so we just played our first game in Toronto. 20,000 people came to see a preseason game for the WNBA. This is like astounding, by the way. So for any Canadians in the audience, thank you. But globalizing the game, so we're going to look at driving that global platform. In India last year, we showed our games for the first time. Over 20 million Indian people watch WNBA games uniquely. So there's huge opportunity globally. So that's what we need to do. We just weren't doing that. We didn't have the scale, we didn't have the human capital or the financial capital to do that.
Well, now you have more capital because Bloomberg's reported that combined league and team revenue is projected to reach $200 million this year, which would be about double the growth in 2019, or the total, I should say. The thing is, the players don't always see the full benefits of that growth. Base salaries as a share of total revenue shrank to 9% in 2022 from 11% in 2019. When you think about addressing this, does it all come down to the next collective bargaining agreement?
Yeah, so for those that didn't follow us, I walked in 4 days on the job and they said, you're going to Vegas to negotiate your first collective bargaining agreement. I said, collective what? So I knew the players were union, obviously. I knew the players had opted out as it was their right to do so. So we did negotiate a very progressive CBA at the time. Now we're 3 years, hence, and now the players want more because we're doing well. And I totally understand it. And those statistics you just threw out are deceiving because we have found every opportunity to put more money in the players' pockets. We're going to pay them $1.5 million in league player marketing agreements this year. I don't know if you're watching the NBA playoffs, but almost every ad or commercial has a WNBA player in it, whether it's Arike Ogunbowale or Nneka Ogwumike or Candace Parker or Sue Bird, who's now retired but still in our commercials. And companies are really stepping up for those ad buys. So we're finding ways. We put a $500,000 prize pool up for our Commissioner Cup in-season tournament that now the NBA is going to do a mid-season tournament, but we did it. This will be our 3rd year of doing it. We upped the playoff bonuses by 53%. I put a $4.5 million charter fund up this year. So we're finding ways that we know what the players value. They value mom benefits, fertility benefits. They value bonuses, things like that. So, those don't always get taken into account in the math. But, as we get into the next collective bargaining cycle, what we're trying to do is set this league up for 40 to 50 years, not just the next 5. So that's why we raised the $75 million last February, because I said I came in from a capital-rich company to a capital-poor company, and I said, not only do we need the financial capital, but that'll give us the ability to get the human capital we need to, again, drive a new digital platform, marketing, because sports, you look, I'm a big studier of history, too. You look back, when the NBA was 40 years in, they were still on tape delay, and what happened? They got a big rivalry coming out of college called Magic Johnson and Larry Bird, and that drove people to watch. And then
the narratives, the people.
And a couple of years later, what happened? Michael Jordan and the marketing machine Nike. Yeah. So, when you think about that, Jordan would have been a great player, but without Nike, would it have become this global phenomenon and this global brand? And again, so studying that and trying to take, and other sports as well, and trying to take that and use the momentum. I mean, I don't know how many people here watch the NCAA Women's Final Four this year, but
thank you.
10 million average viewers of that game on that Sunday. And I was actually at the Masters right after that, and everybody was talking about women's basketball. And I'm like, this is the dawn of a new day in women's basketball. So
Absolutely.
Capitalizing off of that as well.
So sports is now an asset class, and that's why we bring this up here at the Bloomberg Invest Conference, right? It offers uncorrelated returns, the valuations, although they are high, it kind of, everyone's talking about how the sky potentially is the limit because there's so much demand for it. Investment in women's sports is raising team and league valuations as well. You, as you mentioned, completed this $75 million capital raise last year. How are you deploying those funds? What are you investing in? Is it those extra income opportunities for players that you referenced?
Yeah, so it's actually to drive revenue so we can give the players extra income opportunities. I had to actually educate the players. They're like, good, 75 million divided by 144, pay us. It's not really how you grow the league for the long term and for the next generation of players coming in. So they now understand that we do business of basketball, and I think they're going to see big returns going in the future. But, I also tell them you don't deploy capital all in 1 year and expect that return. It's a 3 to 5 year deployment. Again, marketing, globalization, merchandise. I mean, our merchandise sells out, and then it's like our fans complain they can't get this person's jersey or this, which is good news. But that's because the supply is not meeting the demand. So as you grow, you've got to invest in that. We're investing in live experiences at our WNBA All-Star Game, which will be in Las Vegas in mid-July. We'll have a whole event called WNBA Live. We're investing, again, in a variety of things. We just launched a new app, digital DTC. How do we think about our own streaming platform? How do we spend money to make sure media companies see the value? One thing that has fascinated me about sports, it's all a multiple of revenue. It's not based on the bottom line, so multiples of revenue are actually, as we're growing revenue, actually helping us.
So I have to ask about the biggest story in sports this week, which of course is the unexpected merger of the PGA Tour and Live Golf. What intrigued me, though, was how women's golf thought about potentially doing business with Saudi Arabia. And I know you're on the board of the LPGA, because the LPGA commissioner last summer said she would take a phone call from Live Golf because it's my responsibility to evaluate every opportunity. What do you think about that idea, that women's sports can't afford to ignore a potential benefactor, even when the benefactor might not be their first choice?
Right. Well, first, I'm not on the board of the LPGA. I'm on the board of the USGA, which is
My
a
apologies.
not-for-profit about the game of golf. So just, no, look, I think women's sports is really hard. It's like pushing a big boulder up a hill, and whenever you can look at opportunities, but it also has to be whether it's a company that you're looking at partnering with or a country you're looking at partnering with, it has to share your values. And that's how we think about it at the WNBA. So I can't comment on the LPGA or golf specifically, but I do know.
Hypothetically, if Saudi Arabia came to you, how do you think you might respond to that?
I think we'd evaluate it across what our global games platform looks like. It wouldn't be the first place I went for sure, but we have this opportunity like we had in Canada, in Europe, in Asia, and Africa. I mean, Africa would love for a WNBA game to come there. So we'd look at it in the context of maybe an EMEA games, Europe, Middle East, Africa, as part of our global platform. But we'd look at it too, so I don't disagree with Molly, but commissioner, of the LPGA. But it is something I think you have to think through. And the WNBA players, we're running a very player-first, player-led league, and I would go to them first and say,
that's a great
where
answer.
do you want to play?
Final question to you. Women's sports overall, there's a lot of eyeballs, there's a lot of money. It's a growth story. So my question to you is, what stage of the growth are we at? Is it closer to pre-IPO Google? Are we past that point? Do you worry perhaps that it's getting frothy like an FTX in late 2022?
Yeah, I would say we're approaching, the tween years, at least for the WNBA. I think women's sports overall, huge momentum. We're going to get a huge lift off the Women's World Cup soccer this year. We're going to get a huge lift off the Olympics next year. The USA women's national team is going for their 8th consecutive gold medal there in Paris next year. It will be an all-time record in the history of team sports in the Olympics. And guess what? None of you probably know about it, right? We have to market around this. We have to capitalize on it. But I think there's never been a better time to invest in this growth story. We are a sports, media, and entertainment property that is growing.
Cathy Engelbert, thank you so much. Commissioner of the WNBA.
Thank you.
Please welcome to the stage Coinbase co-founder, chairman, and CEO Brian Armstrong with Bloomberg Sonali Basak.
Brian, you're quite the man of the hour.
Oh, thank you.
For those of you who don't know, just yesterday, Coinbase and the SEC have been kind of in this months, maybe years-long dispute here over defining a lot of the crypto environment, and they brought a certain amount of charges against you, to which your chief legal officer yesterday told me that you guys are willing to fight this pretty significantly. When you saw those charges brought against you, what is the first thing you did, and how far do you think you're going to have to go here?
Yeah, well, this was not unexpected. We've been in discussion with the SEC for a long, long time. Even going back to before we were a public company, we started sharing with them how we operate our business, how we list assets on the platform, how we think about our staking program. And through a large number of dialogues back and forth, they allowed us to become a public company. We had many discussions with them in the last year when their tone started to change, and they started to come to us with more questions about the business. So we were very forthcoming. We met with them probably 30 times over the last year. And we started to kind of ask them for feedback. And we said, we would like there to be a robust market in the US to trade crypto securities. Of the 1,000+ assets we've reviewed today, we've rejected 90% of them. The ones we trade, we believe, are commodities. What feedback do you have for this, for us? How can we come in and register? How can we work together? And unfortunately, we were met with silence. We really got no feedback in those 30 meetings. The first meeting where they were scheduled to come and give us feedback, they canceled it a few days before that, and then we got a Wells notice a few days after that. So it's really unfortunate. We work with regulators all over the world, other regulators here in the US. I think I'm a reasonable person to get along with, but unfortunately, the SEC under this chair has taken a regulation by enforcement approach instead of creating a clear rule book in the U.S. that can allow this industry to be built in a safe and trusted way.
When was the last time you personally met with Gary Gensler, and what did you say?
Right. So when he first came in as the chair, I flew out to New York. I reached out to him. Our teams reached out. I tried to make an effort to connect with him in person because that's what I try to do whenever a new regulator kind of comes in. Unfortunately, we were not able to connect at that time. I'm not sure why we couldn't get on his calendar. And we followed up a few times in the year after that. We eventually got a meeting that was virtual. It may have been COVID related or something like that, but we were able to get a virtual meeting. But unfortunately, it was frankly like a pretty icy reception, I would say. We sort of came in hat in hand and said, "Hey, Chair Gensler, you've asked people to come in and register. Respectfully, we're here to register. What would you like us to do? What process would you like us to go through?" And his response was, "Talk to your lawyer. I'm not here to advise you." And that was kind of how the conversation started. And at that point, we realized there was a gap. We felt like this was an important technology that we felt needed to be built in a safe and trusted way here in the U.S. in a way that consumers were protected. And I don't know what his motivations or his personal views were, but it didn't seem like he was on the same page.
So what does this mean for you if the government cracks down so hard on crypto, on Coinbase, the SEC? Does Coinbase exist in 5 years?
Absolutely, we do. And I want to make an important point, which is that the SEC chair may have a certain point of view, but that's not representative of the whole U.S. government. In fact, quite the opposite. I would say the SEC chair is really an outlier here, kind of in the U.S. government. So when I meet with members of Congress, I think the broad consensus, probably amongst 80% of people I talk to on both sides of the aisle, it's a pretty reasonable view they have, which is we don't know exactly what this technology is going to become, but we're seeing every other major financial hub in the world move towards clear legislation. We need to make sure that this innovation happens in the U.S. in a way that, again, let's just protect consumers. Let's apply some basic good ideas around AML, KYC, and audited financial statements, and make sure there's no wash trading. Let's create a clear market structure where, businesses can understand which CFTC, SEC, who should they talk to about which types of assets. So Congress is recognizing this, and the White House is as well. Actually, the Biden administration put out an executive order about a year ago, kind of asking all the branches of government to sort of say, get your act together on crypto. There's some risks, but there's some real important opportunities with this technology. Let's create a clear regulatory framework.
Will you fight this all the way to the Supreme Court? Do you think you'll have to, and do you have the financial resources to do that?
Yeah, so even if this takes some time, that's okay. So in Q1, we were adjusted EBITDA positive as a company, even in the depths of this crypto bear market, if you want to call it that. We have over $5 billion on the balance sheet, right? So, and frankly, even though that this complaint came in from the SEC, it's really business as usual today, right? We're continuing to trade the assets that we have on our platform. We trade over 200 assets on our platform. The SEC complaint mentioned just 13 of them, so a relatively small percentage of the assets we trade. We also have business overseas in other countries. We derive a lot of revenue from other sources that are not related to trading fees. So Coinbase is well capitalized and adjusted EBITDA positive in Q1. I think we're going to be fine going to court. In fact, it's a relatively small portion of our company that, we have a great legal team, policy team, et cetera, that's working on this. And what I really want, 90, 95% of the company to be focused on is just building great products for our customers and making sure we don't lose sight of that. And so this is a very serious matter that I'm going to work on with a couple of our executives. But really, the vast majority of the company needs to keep building because that's how this technology is going to ultimately benefit 1 billion people, hopefully.
How long does the regulatory overhang last? The reality is this could take many, many months. And do you think that your investors might lose some faith, or even your customers, while you go through this?
Yeah, well, I mean, look, this is not a new concept, right? There's been lots of discussion. The SEC has had rhetoric around this for several years that I think has influenced the market. And so the investors in Coinbase are, comfortable with that because it's all public, right? And it's not like some secret thing that's being revealed. And I think they're taking a long-term view that Coinbase is a very different company. We're kind of an N of one, right? We're really the only company that was based here in the US that went public, that has audited financial statements, that's taken a compliance-first approach. Even in this recent SEC complaint, by the way, that came out yesterday, it was unfortunate they sort of did it back-to-back with another complaint that went out there. That may have been intentional to try to conflate the two, but I think people are smarter than that, and they recognize that this complaint against Coinbase, there were no allegations, no allegations of misappropriation of customer funds. There was no allegations of wash trading. Myself and the executive team were not named personally. It's really debating this more technical legal question of, are some of these assets commodities or are they securities? And I think that's something the court will have to decide to sort of get some legal press, some case law out there, which will ultimately benefit us, because that's what we've been asking the SEC for a long time, is how do we get more clarity? So if we need to go to the courts to do it, it's not our first choice. We'd rather the regulator had just published a clear rule book. But if they're not going to do that, the courts are there in the US to avail ourselves of.
So part of this was about securities being registered or not in terms of how they're listed on your exchange, but part of this was about staking also. So staking obviously is becoming a more important part of the crypto ecosystem. Do you plan, based on how the regulators are treating staking, to wind down your staking service?
No, we're not going to wind down our staking service. Again, as these court cases play out, it's really business as usual. We're going to continue to operate that. Staking only represents about 3% of our net revenue, but it's a very important function in the crypto community, and it serves an important part of these decentralized blockchains. And I guess I should mention also that Coinbase's staking product is architected and built in a way to be compliant, and we actually think it's materially different than some of the other ones out there which have been called staking. And so, yeah, we're going to continue to operate our staking business.
So if users wanted their funds back in the staking service at this point in time, does Coinbase have the ability to service that at scale in case that there is a larger run on the staking business?
Yeah, so staking is really something that's a decentralized part of these decentralized protocols. So Coinbase is really just it's a pass-through mechanism. We're helping people access these decentralized protocols. So some of the decentralized protocols have, for instance, like a lockup period of some number of days when you initiate the withdrawal request. And so we're just making that kind of information available to the customer. But it's all the funds are there backed one-to-one. When you're staking something, it's being pledged into these decentralized protocols, and we actually don't even have the ability to move it somewhere else at that point. We're just giving people access to these decentralized protocols.
Should the business face withdrawals, does that have a material impact on Ethereum's price? And how does Coinbase prepare for something like that?
What do you mean?
Is there kind of a broader run that you have to be prepared for?
Oh, well, okay. So in our business, we're not a bank, right? We don't do fractional reserve, and so there's not really this concept of a run, right? All the funds are there backed one-to-one, and you don't have to take our word for it. As a public company, we have auditors, Deloitte in this case, who's gone in and verified all of that. You can kind of confirm it in our financial statements. So, if people want to withdraw funds, 100% of it is there. There's no such thing as a run, really.
So how do you answer the question of, on one hand, there is the SEC that is, causing a big overhang in terms of both you guys and the industry. On the other hand, just financially, rates are higher in the United States.
Yeah.
People are more inclined to keep their money in a bank. Why should they keep their money with you?
Well, what's interesting in crypto, there's been the evolution of something called stablecoins, right? And so we're actually in consortium with another company in Circle in the space. We've created a USD coin, which is the second largest stablecoin out there. And as you mentioned, interest rates in this environment, that's been both a good source of revenue for us, but it's also something that we've passed along to customers. So customers can actually earn rewards on USDC and get access to some of these higher interest rate environments.
Broader question, not just about Coinbase, but about the industry. As more regulatory enforcement actions come to the forefront, how much of an overhang do you think that will have on crypto pricing?
It's hard for me to say. It was actually kind of surprising. Yesterday with this complaint that came out, crypto was up, which I would not have expected. So I don't know what to make of that. I don't know if it means that people knew something was coming, but they expected it to be worse, than it actually was, or if they just felt that they're still a believer in it or something. But I don't try to predict what's going to happen in these markets. We don't operate a hedge fund or anything like that. We just want to provide a good service to our customers around the exchange and all the products we offer.
Before I let you go, I want to ask about not crypto. I want to ask about artificial intelligence. We've been talking about it all day. As a crypto entrepreneur, how do you see AI? Do you see it as a competing factor in terms of dollars going towards technology? Do you see it dovetailing with your industry at all?
Well, AI is certainly one of those couple really important technology trends that the U.S. needs to get right, along with crypto. And I think we're seeing a similar question start to happen in Congress along with crypto is like, hey, how should this be regulated so it can be done in a safe, trusted way? I do think there's a couple interesting intersections between AI and crypto. One of them is that, in the world of AI, it's so easy to mass generate things, whether it's a news article or images. And so the provenance of those and the authenticity of it can be a little bit hard to figure out. And in a world of crypto, one of the great things about crypto, with NFTs and whatnot, you can actually have a digital signature that proves, this was issued by Bloomberg or by Brian Armstrong or whoever. So I think it could be useful to track the provenance of creative works, whether that's text, audio, video, etc. The other thing that might be interesting is that a lot of these bots or autonomous agents in the AI sphere, they're going to need to go get things done in the world, right? People are already using them to sort of say, hey, order my groceries, or maybe build this website and spin up this server. And so they're going to need financial money. They're going to need money to go do things in the world, these AI agents. And so I think that actually in the future, you're probably going to see a lot of crypto transactions happening between AI agents or AI and various businesses around the world, because crypto is kind of the native money of the internet. The internet is global, it's decentralized, every country, everybody in the world can participate in it. And so it wouldn't really make sense to use the dollar or the euro in a truly global context if you want to be country agnostic. So I think AI will use crypto more.
How much are you actually working on that future?
So we're not trying to build something that is allowing bots to transact in crypto at the moment, but what we are doing is we're building good infrastructure, picks and shovels, if you will. So with Coinbase Cloud, for instance, we're making our APIs around how crypto is stored and transacted and commerce happens. And we're just exposing those kind of like Amazon Web Services, but to any business that wants to integrate it. So I suspect more businesses will integrate that over time, and some of those may use AI. We're also using AI in our business in a few other ways. I mean, we use it a lot for fraud prevention. Unfortunately, we get people signing up, putting in stolen credentials and things like that. And so we've developed a lot of really good machine learning to detect that. And we're testing it in a few other areas too, just like around. Actually, our design teams, they'll sometimes look at Midjourney or DALL-E and sort of generate an interface using AI. Or at least, show me 5 ideas for what an interface might look like to do remittances in crypto, or for content creators to have a direct relationship with their audience, and what would the interface for that? And AI is just like a great assistant. It doesn't. I don't think AI really is taking people's jobs. It's taking tasks off their plates, largely, to make their jobs more efficient. And so having a research assistant or someone like that, a tutor, a mentor, a therapist, whatever, everybody can have one of these paired with them, and I think it'll just make humans more productive.
Brian, we're out of time, but thank you so much for your time and for taking our questions.
Thank you.
All right, we hope you enjoyed the programs this morning, and it's actually now time for lunch. So please make your way out of the auditorium, where Bloomberg staff will guide you towards the bank of elevators to take you up to the 29th floor. You can enjoy the views and your lunch there. For those of you who registered for the breakout lunch session, Building a Portfolio with Solid Infrastructure, which is proudly sponsored by Principal Asset Management, please also make your way up to the 29th floor, where our staff will direct you. And if you are tuning in to that lunch session virtually, please scroll down to the next session on the agenda tab, and you can click to join the broadcast there at 12:15. So for those of you still sitting here, our main stage program will resume at 1:30 p.m. sharp. And this afternoon, we'll be featuring conversations with Mark Lasry, Ray Dalio, and financial content creator Kyla Scanlon. So enjoy your lunch. We'll see you back here soon. Same place, yes.
Took time off from my kingdom. Took a break from the war. Took time off from my kingdom. Raise up my creatures. Diamonds from space. Pure facets and features. Drop from your lips, making you think I could and was to let baby kiss some of those hot thoughts. Melting you cool, could be that so on my mind. Signal and cues you got. Hot thoughts all in your mind, all of the time. Oh, they do my rhyme, make it your mind, yeah. I think all your love is enough.
You touch my favorite Russian lullaby. You've been running around on that all day, searching for the right things to say.
conversation, but it's just a string of empty words. You've been carving out a smile, all you wanna do is burst. Well, there's nothing you could hide that could ever be too dark to tell. And I'm crossing all my fingers that you'll come out of your shell. And now you can hang your heart up on my wall, just the way it is, the way you are. Yeah, you can hang your heart up on my wall. I won't let it down, won't let you fall. I've been trying to put my finger on the thing that really makes you glow. I've been soaking up your eyes, you don't even seem to know. I know